the rest of this iPhone 15 cycle is essentially going to show year-over-year declines out in China. And as we kind of go into the fall, something that Apple is missing is AI capabilities, and that is something some of these China vendors are starting to show. China also has a leg up in the sense that they are releasing more and more foldable phones out there, which the consumer likes. That's something Apple does not yet have in its pipeline as well. So if they can kind of answer some of the questions on the AI side of things, showcase some new capabilities out there for the consumer, I think that helps the China story as well.
On a broader level, Angelo, can Apple charge more for phones with AI?
I think they can, and a big reason for that is, I think consumers out there just love the Apple brand out there. I think the way kind of Apple showcases the messaging when it comes to kind of new capabilities on their ecosystem, I think really gravitates to the consumer out there. I know when Dynamic Island kind of came out with the iPhone 14, there were a number of individuals that actually kind of went gaga over it. So AI, I think, is going to be a much bigger deal than that. But that said, yeah, I mean, I think if they can kind of wrap this up nicely and sell it to the consumer in a positive way, at the very least, I think you can potentially kind of increase the price point on some of those pro devices out there, and again, show a return to growth on the iPhone side of things.
Angela, when it comes to the price point in China, given the fact that we have seen this uptick in the March data in terms of iPhone sales, do you think Apple's now at a sweet spot in terms of pricing in mainland China?
Tough to say. I think this has definitely become a more competitive market. You kind of heard Tim Cook kind of illustrate that. I think he almost alluded to the fact that China at this point is essentially the most competitive market out there. So, it's going to be difficult for Apple to really continue to sustain that market share that they've just soared here in 2023. In fact, we do expect them to be a share loser here in 2024 and likely an incremental share loser in the foreseeable future. Now, that said, they can continue to grow in that region, or at least sustain revenue in that region. We think if they can kind of continue to incrementally increase pricing through new capabilities. This is something they've done here over the last 15 years or so across not only their iPhone ecosystem, but across their entire hardware ecosystem.
Angelo, just finally, is it just me? And you can say it's just me if you want to, but is the product seemingly getting worse on the iPhone side of things? The bugs on FaceTime, the headphones haven't really improved. Angelo, what's happening there?
I think it's you. I think it's one of those things where, for us, I mean, the experience on the iPhone side of things has improved on our side. But yeah, I mean, listen, I think you're always going to have your hiccups across that ecosystem out there, as well as kind of other, mobile devices as well. So, our view is, it's probably the best experience you're going to continue to get across different mobile operators out there.
I'd expect nothing less from a man with a 210 price target and a buy rating on the name. Angelo, thank you. Angelo Zeno, CFRA. I'm not the only one. Well, every family member's got that issue.
It's their fault too. Evidently, you just need to do it better.
FaceTime playing up.
I mean, having delays.
The issue I have is the battery life. When a new iPhone comes out and you start to notice your battery gets drained quicker.
Solution. Let's take $2 billion of that $110 billion share buyback and put that into an effort to solve all of those issues. Okay. Wouldn't that be good?
All right. So, right,
just the $108 billion.
So he's basically, he's trolling us to try to say, well, maybe this is deliberate. Maybe they don't want to do that because this is something that encourages people to buy more phones. This is
because we're stuck in the ecosystem
of Apple, which is the reason why.
That's what Marguerite Vestager would say. We're stuck there.
And that's what Lena Khan would say too. She would just completely agree with you.
You could be the next FTC chair, John.
I don't think that's going to work out. I think everyone's happy with Lena Khan, aren't they? Well, both sides of the aisle.
For the most part.
Yeah, well, not on Wall Street, but
that's a different question.
Politically, yes.
Yes, I meant everyone down in Washington. Let's get you an update on stories elsewhere. It's my fault. Of course.
Obviously.
Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
I think it's buggy too, John. Okay, anyway, a second advanced world central bank has cut rates. First it was the Swiss, and today it's the Riksbank cutting rates for the first time in 8 years. Now, the debate has been, can you cut before the Fed or even before the ECB? But the decision indicates that concerns over recession in Sweden take precedence over concerns of a weakening currency and that impact on inflation. Riksbank said that they could cut possibly twice more this year. Donald Trump's criminal trial for allegedly mishandling classified documents has been postponed indefinitely. Trump was indicted on 40 criminal charges for allegedly taking government documents when he left the White House. 3 of 4 criminal cases against the former president have now been postponed until after the election. Trump is currently on trial in New York in a hush money case. And the first crewed mission of Boeing's Starliner space capsule has been delayed until at least May 17th. The delay comes after a technical issue prevented the initial flight, which was supposed to take place on Monday. It was halted during countdown due to a potential issue with an oxygen relief valve in the rocket, which is run by United Launch Alliance, not Boeing. The space flight has taken on greater significance with Boeing navigating a leadership shakeup spawned by a safety crisis with its 737 MAX 9 jet. That's your brief, John.
Hey, Danny, thank you. We'll catch up with Danny again in about 30 minutes' time. Up next on the programme, too soon to declare victory.
The second half of 2023 surprised us at how rapidly inflation fell. It seems like it's stalled out. So it's a little too soon to declare that we're definitely stalled out, or maybe it's just taking more time.
Great exchange on the ground at the Milken Conference with Romain Bostick and Carol Massa sitting down with the Minneapolis Fed president. Much more on that conversation in just a moment.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of, I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Equities just about unchanged on the S&P 500. Welcome to the program. We're slightly negative. We're down by 0.02%. In the bond market, yields retracing some of the move over the last week or so. We're higher by 2 basis points at 447.74 on a US 10-year. Under surveillance this morning, too soon to declare victory.
We're committed to 2%. We will get to 2%, and we will get an interest rate environment necessary in order to achieve 2%. The second half of 2023 surprised us at how rapidly inflation fell. It seems like it's stalled out. So it's a little too soon to declare that we're definitely stalled out, or maybe it's just taking more time.
It's the latest this morning. Minneapolis Fed President Neil Kashkari urging caution, adding the Fed will likely keep rates on hold for a, quote, extended period. More Fed speak on tap with Jefferson, Collins and Cook all speaking today. Janet Henry and the team at HSBC expecting the Fed's first cut in September and expecting the ECB and BOE to move in June. Janet joins us now for more. Janet, some people might say September has become the new June. What is the risk that December becomes the new September and pretty soon?
Yeah, there's always risks where markets are concerned, as you well know. It's not so long ago that markets were pretty convinced that the first rate cut was going to be in March, and then it briefly went right to the end of the year. And you're right, September for us is the new June, but you'll also know that back in December we were saying June. So it really will depend on the data. But as Powell keeps telling us, it's the totality of the data. Yes, they need to see further improvement on inflation, but they don't need to wait until they get back to 2%. But the urgency with which they will feel the need to act will depend on all of the data, including the labour market. So it may be that, you know, the progress on inflation is relatively modest, but if they see more that scares them in the labour market data, that could cause them to act. But if in December we're still at unemployment less than 4%, still getting payroll prints of 200,000, and inflation, core PCE, is still above 2.5%, then what's the urgency?
It's pretty impressive. It's not where we thought we would be, even 3-4 months ago. Janet, let's talk about September, not the economic data. Can we just talk about the politics briefly? You're not alone on September. Other people have that marked on the calendar as well, including Ellen Zentner over at Morgan Stanley. I think the natural question for us to ask is the politics relevant here? Going into the election in November, is September still an option that's open to this Federal Reserve?
I think every meeting is open to the Federal Reserve, because I think in anyone's scenarios, including the most likely scenario for any FOMC member, is the next move in rates, and any scenario is still on the table. The next move in rates will be a small one. We're talking about a 25 basis point move in rates is what's going to happen. Now, while that is consequential, because hopefully it will be the beginning of a sequence of rates, even if it's not every quarter or every meeting, maybe it is a bit more intermittent, they will take the decision when it is appropriate based on the data. I don't think it will be, oh, we've got to wait until after the election, we can't be too political. Yes, a lot of them will be having that thought at the back of their mind, but it will be about what is most likely to settle inflation at least a bit more confidently back on track towards the 2% level, even if we never really get there, without inflicting more damage than is necessary in terms of what's happening in the labour market.
But Janet, whether or not they come out and they say, we don't plan to be political, that's going to be the optics. So what's the bar in the data they need to see to almost feel comfortable about taking that move, knowing that many are going to view it through this political lens?
Well, you know, we get back to the data. You've got to remember, in the last set of projections that we had back in March, what was in the Fed forecasts for core PCE for the end of 2024 was 2.6. You know, we're at 2.8. We know this is a bumpy ride for inflation, but just as everyone got overly excited at the end of last year on a few downside surprises to the inflation releases, they've got really, really hawkish early part of the year when inflation surprised for 3 months by about 0.1, you know, on a monthly basis for that kind of period. So I think what they do need to see now, it seems, to really pull the trigger is get a core PCE print that probably is more like 2.5. As the headline figure, but they will also need further evidence in the data, slower growth, slower employment growth in particular, and the wage numbers. You know, that's by no means the most important factor, but the more 0.2s we get on monthly inflation and the lower the payrolls release, that's probably what we do need to see to get that September rate cut.
Say September comes and goes and they don't make that cut. Do you think they push it to December, or there is a chance that November could be a live meeting?
I think it would be unusual to cut in an election month. In fact, when we looked back at this, and certainly when I spoke to other previous FOMC members, they could only remember one meeting whereby the timing of an election, and I think it was a midterm election, actually influenced the Fed's outcome. And actually it was under Greenspan ahead of a midterm elections. But the next move straight after the election was a 75 basis point move. So it was really consequential when you're delivering a rate rise of that kind of magnitude. So I think November will be unlikely. For me, it really is a case of we either go in September or we wait until December, but I wouldn't rule anything out.
One of the most interesting aspects of your forecast is that you now call for 25 basis points of rate cuts this year. It was 75 basis points previously, but you keep your forecast for 75 basis points next year. Do you think that we're heading toward a higher neutral rate than you previously expected?
Well, I've long been highlighting over the last few years that we are moving towards a higher neutral rate. Obviously, the movement on the dot plot and the longer term dot from the FOMC has edged up from 2.5 to 2.6. But I really get the impression from various FOMC members that they actually think it's more like about 3%. But I guess what we've got in our projections is the idea that policy will need to stay relatively restrictive. And I think this is what you might hear from more central banks. You could potentially hear something like that from the Bank of England tomorrow. The idea that rates can be cut a little bit and still be restrictive. If we're still at 4% Fed funds, which we are on our forecast by the end of 2025, arguably that is still restrictive to ensure an ongoing disinflationary process. We don't have core PCE at 2% by the end of 2025.
Janet, well said. Appreciate the clarity as always. Janet Henry there of HSBC breaking down the Federal Reserve. 25, such an interesting year. Think about it. How difficult it is to have a view on next year without any kind of clarity on the expiration of tax cuts, what's going to happen with tariffs if President Trump gets another term in the White House. All of these things are going to have big implications for what happens with the broader economy.
Which is the reason why I find it interesting that Steve Eisman said yesterday, well, it won't really make a difference one way or another. A lot of people are just, what was it, Lori Calvasino? The blinding white light of the sun.
Yeah, looking at the sun, staring at the sun.
Have to care about it, but...
That's 2025,
yeah.
Staring at the sun. Coming up next on the programme at a second hour of Bloomberg Surveillance, we'll catch up with Tracy McMillan of Wells Fargo, Bloomberg's Mike Shepard, and Enda Curran and Maddie Zhu.
Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
margins are already very high, but companies will probably be able to maintain them.
We will grind higher from here, and we think there's upside.
You can make the argument that the market overinterpreted the weakness of the earnings data.
There is still room for repricing to take place, which is why we're overweight U.S. equity.
We expect market to move higher, but it's not going to be a smooth path.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now. Live from New York City this morning. Good morning, good morning. One stock on the board right now in the pre-market sinking, getting absolutely hammered. It's Uber. It's down by more than 8%, Lisa, in early trading.
Uber is an interesting story because on a broader level, consumers are spending a lot on going around and riding around. Have they reached their price tolerance limit? Their bookings were lighter than expected. The gross bookings for the first quarter came in at $37.65 billion versus the estimate of $37.97 billion. But this is the issue. The forecast came in on the weaker end of what they expect to see. This is a protracted, perhaps, slowdown in terms of relative to expectations.
It's difficult to get a clean read on the consumer right now, but we'll do our best. We've been talking about high-end stability and low-end fragility. This from Mike Wilson of Morgan Stanley in the last couple of days. We would describe the consumption backdrop as bifurcated between high-end stability and lower-end weakness. We think staples over discretionary makes sense for that very reason. But we've spoken to a company in the last 24 hours where there's a very different story to tell. The Walt Disney Company talking about the theme park business. They put up prices. Business is okay.
It's a confusing moment because it's very difficult to know what is discretionary. Some people might say that Disney isn't discretionary. They go to Disneyland every year with their whole family. It's a staple in their lives. They'll save everything for it. I don't know if that's representative. What you are seeing with Uber and what you saw yesterday with the consumer credit reading that we got from the Federal Reserve was that people were borrowing a lot less than they previously had expected. You can say, well, it's not buy now, pay later, all sorts of asterisks. A question of, are people now seeing that weakness that we've expected for quite a while?
Well, two things. I still think coming out of the pandemic, people are leaning into services, the likes of Disney. You couldn't go here. You wanted to take your family. You were stuck at home. They still want to go out and have those experiences, especially in places like Asia, which were locked down. Look at China, locked down so much longer than the United States. Also, look back to the conference board. Yeah, the last one, people are talking about concerns about the labor market. But for a while, the real concerns have still been inflation and everyday goods like gasoline and groceries.
Uber's down about 7% in early trading. Let's get the broader price action for you. On equity futures right now on the S&P 500 shaping up as follows. We're negative by, let's call it 0.1%, just a little bit lighter after 4 days of gains on the S&P. In the bond market, after 5 days of falling yields, they're climbing a little, up a touch, up 2 basis points on a 10-year to 447.74. Coming up this hour on Bloomberg Surveillance, we'll catch up with Tracy McMillan of Wells Fargo with stocks on a 4-day winning streak. Bloomberg's Enda Karen on Xi's trip to Europe, and SIBO's Mandy Zhu on how the US election is already being priced into financial markets. We begin with our top story. Stocks edging out a 4th day of gains. Tracy McMillan of Wells Fargo writing this. We remain more cautious at current levels in both fixed income and equities until valuations improve and better opportunities present themselves. We expect to see broader opportunities in equities over the next 6 to 12 months. I'm pleased to say that joining us now is Tracy. Tracy, let's talk about this. More cautious on both stocks and on fixed income as well. How does a view on one asset class inform the other currently?
Good morning, John. So we are cautious on both equities and on fixed income, and we're really waiting for better opportunities to add to both of those asset classes. Right now, what we see is that at the short end of the fixed income curve, the yield is over 5%. And so you have to compare that to the opportunity in equities. And our large cap forecast for the end of 2024 is 5,200 at the midpoint. So there's not a lot of upside potential that we see in equities going out to the end of 2024. Now, 2025, we think could be a better year. So we continue to favor large cap equities. But right now, the balance between the risk reward between fixed income and equities does have us more cautious in equities, going up in quality in fixed income and staying towards the short end of that fixed income curve.
Could you clarify something for me? How do you think bonds would behave in a drawdown in equities? Would they still perform well?
Yeah, so that's a really interesting question because over the past couple of years, what we've seen is higher correlations between both equities and fixed income. And that's because of the driver of the downturn in both of those markets, or conversely, the upturn in both of those markets. And that's been the expectations for interest rates based on inflation. And so as inflation expectations have changed, we've typically seen bond yields rise, we've seen equities come down, so both of those negative at the same time, and then conversely. What we are telling investors is that going forward, that should start to normalize as inflation comes under better control. And diversify into assets that do not have that strong positive correlation right now, like commodities and alternatives.
I'm wondering, you talk a lot about the consumer and a weakening in the consumer. How much can we get a read of that from the recent earnings, which have been pretty strong on an earnings per share basis? But you've seen revenue come in light at a number of places, including at Uber. They're talking about bookings coming in lighter than expected, expecting that to continue. They talk about Latin America bookings having to do with this. They talk about early holidays. Do you think this is evidence of just tighter competition, of price pressure by the consumer, or all of the above?
It's probably all of the above, Lisa. What we're seeing in terms of the consumer is that, and you mentioned this a little bit earlier, consumer confidence does appear to be waning. And there is a bifurcation, as you also mentioned, in the upper income quintile and the bottom four income quintiles, which have exhausted all of their pandemic savings. So really relying on just that upper end consumer now to carry the market. We'll see retail sales next week, and that will give us a further indication of whether or not consumers are continuing to spend. But some of the underlying information that we're getting out of recent data and recent reports is that consumers are pushing back on some of the price increases, and that companies are feeling less confident about their ability to raise prices. So all in all, that could be good for inflation, but we do see the consumer starting to pull back in aggregate.
I think a lot of people would agree with you, Tracy. The issue is just the speed and exactly where this is going to go in terms of the weakening. You have some people come on and say, we're going to see a protracted weakening and we're going to get that true downturn. Francis Donald of Manulife talking about that yesterday. And then you have other people saying, actually, it's just the appropriate softening to allow small caps to rally. Which camp do you fit into?
So we do think that we're going to see more of a soft patch. We think that the data last week is supporting that view that we'll probably see that soft patch, growth slowdown, labor market slowdown starting to occur in the second half of this year. So, more of a soft patch. We think there's less risk of a recession than there was in 2023. But that doesn't necessarily give us the refresh, the reset that we would need, the clearing of markets that we would need for small caps to reassert themselves. Small caps really for decades now have seen the ranks of non-earners increasing. And that gives us some longer term concern about small caps. So there's certainly a place in the cycle to invest in them. We just don't think that the time is quite right yet.
Tracy, all morning we've been talking about the developments in the Middle East, and in your note you talk about how this could still be a risk to oil prices, which we've seen pull back quite significantly. What kind of upside do you think we can see in the oil market?
Yeah, we have a price target on oil of between $80 and $90 a barrel through the end of this year, but we could see towards the upper end of that target range if we were to see oil trade restricted more in the Middle East. We did get good inventory numbers here in the U.S., and certainly U.S. producers could ramp up production, but that will probably take a little bit of time. And in the interim, we could see some supply constraints that would push prices higher. And don't forget about, OPEC being able to bring on more supply as well. So we don't see oil prices necessarily skyrocketing, but we could see certainly the upper end of that range. And we think that would, again, put pressure on markets because it could imply inflation.
If that were to be the case, say $90 a barrel, where would you potentially want to shift in your portfolio?
Yeah, so we have already shifted towards commodities with an overweight there. Again, the non-correlation, we like that about commodities. We've certainly seen precious metals performing well, gold in particular, and we think that oil does have some upside from here. So, a commodities position we think is probably a smart thing to do at this point.
Crude a little bit lower on a session this morning. Tracy, always wonderful to hear from you. Tracy McMillan there of Wells Fargo, kicking off a conversation about the broader market and on the consumer as well. New Yorkers loaded. Do you want the stats? Amazing.
It is amazing.
Global ranking of the wealthiest cities by Henley & Partners. That's an immigration consultancy. Here are the numbers for you. 350,000 millionaires in this city, which is the most of any city and up 48% from a decade ago. That is 1 in 24.
I saw that statistic and I thought to myself, was that just the people who can afford to live in Manhattan? Or is that essentially, just because there is opportunity here, or is it a little bit of both?
I saw the statistic and thought, wow, I sit with two of them every single morning.
AMHD. I'm not the one with the 2% mortgage. What are you talking about?
All right.
That's true. We sit with one of them.
What are you talking about? 60 billionaires, 744 people with investable wealth of more than $100 million. And for all the talk of Florida, let's give you some numbers on Florida, okay? Because we're all talking about Wall Street South now. Miami ranked 33rd among the cities with the most millionaires, up 78% over the past 10 years.
So some people would say, rife opportunity, start building, because that seems to be the direction of travel. Look, a lot of people have been talking about the out-migration from New York City. It's been talked about. It looks pretty crowded to me, and the numbers pretty much back it up.
Top 5, New York City, the Bay Area, Tokyo, Singapore, and London, just about still in the mix as well. Let's give an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John, let's get you a quick check on Rivian. Shares lower in the pre-market by 6.7%. The EV maker's earnings fell short of expectations, but it's still stuck by its plan to build 57,000 vehicles this year. Rivian had previously warned investors that it would shut down its Illinois assembly lines in order to make upgrades and produce a lower-cost model. Evercore analysts, though, said that investor questions will remain until Rivian shows proof of both execution and demand. Reddit shares, for their part, surging pre-market, up 14 1/3. They posted better than expected results in their first quarter since IPOing. Revenue increased 48%, far surpassing analyst estimates. The company said the growth was thanks to investments making the site easier to use and improvements in its ad targeting technology. Shares, though, are slightly lower since the trading debut in March. Now, Panera Bread is no longer going to be selling its caffeinated charged sips drinks. The drinks, which famously included an ultra-caffeinated lemonade and some other fruit drinks, were the subject of at least 3 lawsuits, claiming that people who drank them were harmed or even killed. The drinks had up to 390 milligrams of caffeine per 30 ounces. In other words, that's about 4 times the amount of caffeine in a cup of coffee and more than some energy drinks. Panera said it would introduce new beverages to come in the next 2 weeks, like a blueberry lavender lemonade. And that's your brief, John.
What is it with lavender at the moment? Danny, thank you. What is that about?
It's the new pumpkin.
That's the craze?
I love lavender.
Really? But as a soap?
As a soap, before bed.
To taste it as well? Sure, I know, but
sure, these are all things that are not in there.
No, I like lavender lemonade.
Okay, so like lavender's like the summer thing, and then pumpkin's fall. Is this the new trend?
No, I don't like pumpkin. It's too much. But lavender is supposed to relax you, so it's weird to put it in a caffeinated drink.
I like pumpkin.
Very confused. All right. Up next on the program, Bite Dads, biting back.
Rest assured, we aren't going anywhere. We are confident and we will keep fighting for your rights in the courts. The facts and the Constitution are on our side, and we expect to prevail again.
That conversation coming up shortly, live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Equity futures on the S&P, just a little bit softer. We're negative by 0.1% on the S&P 500. It's a mild pullback. Yields are up by 2 basis points, 4.48 on a US 10-year. Under surveillance this morning, ByteDance biting back.
Rest assured, we aren't going anywhere. We are confident and we will keep fighting for your rights in the courts. The facts and the Constitution are on our side, and we expect to prevail again. While we make our case in court, you'll still be able to enjoy TikTok like you always have.
So here's the latest. TikTok's parent company ByteDance suing the US government over a law signed last month, forcing the company to divest the app by January or face a ban in the US. TikTok arguing the law is unconstitutional and violates the First Amendment rights of its 170 million users. Bloomberg's Mike Shepard joins us now for more. Mike, highly anticipated. Here it is. What does this look like now? Is this going to take months, quarters, years?
This is not a case that will be handled on an emergency basis. It's clear that the courts are not treating this as something that will have to be resolved tomorrow. The law, as signed by President Joe Biden, gives the company until January 19th of next year to find a buyer for TikTok. And even after that, the president could extend it by another 90 days. So we were already talking about a year to potentially to resolve the whole matter. However, ByteDance is not interested in that kind of resolution. It made clear in its court filing yesterday that not only does it not want to sell, it sees it as both commercially, technically, and legally unfeasible.
Mike, when it comes to potentially using that 90-day option, it looks like this is a lever that we'll see the Biden administration pull. That firmly puts it in the hands of the next administration. How can we see Biden either continue on this path or Trump deal with this come 2025?
Well, it's a great question there, Anne-Marie, because politics has played a role in this really from the start. You'll remember that Donald Trump, when he was president, actually signed a ban, an executive order banning TikTok in this country. Now, that was stopped in court. There was not enough authority, the judges said, and it also raised some of the very questions that TikTok is arguing right now, that it infringes free speech rights. Now, the question is, how will Donald Trump handle it going forward? He came out most recently against this move to force TikTok to be divested or banned. And he called the law flawed, and he said it would benefit the parent company of Facebook, which had banned him in 2021.
When it comes to what happened in Montana, do you think that's a harbinger for how this will play out?
Well, TikTok is really raising the First Amendment as its primary argument against the law. And in any sort of First Amendment case, the court set a really high bar for any restriction on speech. The government is going to come in with a national security argument, saying that TikTok poses a risk to U.S. security because China could have access through the Chinese parent company to U.S. user data, and it could use the platform to sow disinformation. However, TikTok in its case is arguing that, look, in crafting the law, Congress didn't provide enough evidence to back up those arguments. So we will see how the national security argument that the government has put forward, literally in the law itself, plays out against the First Amendment claims that the TikTok and its lawyers will be seeking to defend.
Especially because TikTok is arguing that it spent more than $2 billion to move a whole host of their data over to an Oracle cloud to try to insulate it from some potential manipulation. How much do you think, on a broader sense, this is going to stymie the administration's efforts to use national security in such a broad set of things?
That's a great question, Lisa, because national security is really driving a lot of the moves that we're seeing, these export controls and other measures. And this one is a little more sensitive because it crosses into more than just commerce. It really is free speech. It's the First Amendment of the Constitution. And I'm glad you brought up the project that TikTok has spent roughly $2 billion on to try to fence off this data of U.S. users away from really any foreign government's ability to access it. However, Congress is aware of that project, and it still proceeded with this law. So it really now does come down to a collision in the courts between the two sides.
How much does it really matter, Mike, in the sense that a lot of politicians are going to try to pass certain rules that will go into effect? The challenges are going to take a while to work through the court system. They can get an easy win. They can make a statement. They can change a market. And then later on, if it's overturned, they've already had their impact.
Well, for some of the politicians in Washington, they're willing to wage that fight. Rand Paul, when the bill was passed, warned that, hey, look, this is not going to hold up in court. He opposed it for other reasons, too. But that was one of his arguments that, look, we shouldn't even be bothering with this because in his view, it ran the risk of being overturned by a court. Nonetheless, there are a number of lawmakers here who viewed it as a matter of principle that, the U.S. government needs to take a stand against a potential risk that China could be using a legally viable platform here in the United States to do some things that could undermine national security. And what we'll have to watch for is during the court arguments and as this all unfolds, whether we get more evidence of what kind of threat does the government, do national security officials and members of Congress actually see in this platform.
Well, talking about national security, the Financial Times yesterday had a story saying the U.S. revoked export licenses that allow Intel, Qualcomm to supply Huawei with certain semiconductor chips. Shep, as we get closer to the election, do you expect more of these restrictions to happen and the Commerce Department to really try to tighten the reins when it comes to what they are allowing China to get their hands on?
Well, the Commerce Department has signaled through Secretary Gina Raimondo an interest in maintaining not only the U.S. technological edge, but also preserving that edge for the sake of national security. It's a commercial argument and competitive argument, but it is also a security argument. And she even said in remarks a few weeks back that technological security is national security. And so they are looking hard at all these areas where an edge is needed to be maintained. And Huawei is interesting because it was already subject to so many restrictions. And by this point, for the two U.S. companies affected by these measures that we also reported on yesterday, the business that they do with Huawei is negligible. Nonetheless, there's a high symbolic value in the move because it shows that the U.S. government is taking this very seriously and is really trying to send a signal to China that, look, there are two tiers of access to technology that you get, and we want to preserve the most advanced technology for the U.S. for not only the competitive reason, but also the security reason as well. And we could look for other steps to be taken in key areas like artificial intelligence and quantum computing going down the road.
Mike, let's finish here. Let's put it all together. What kind of signal do you think that China has received based on these two issues? Is the message from America, we can only go so far?
Yeah, that's a great way to put it because, we've heard the president and Gina Raimondo and other members of the administration, including a few who visited China recently to meet with senior officials, put in roughly those terms that, we don't want delinking, we don't want decoupling, we still want to do business with you, but we recognize that, we are not exactly aligned politically and commercially and on a security basis too. And so therefore, we can only go so far and that we need to make sure that we maintain this technological edge for all those reasons. And so you are not seeing a push for delinking. We still want to do business with you, but it will be at certain levels.
It's a difficult balance, that's for sure. Mike, thank you, sir. Mike Shepard there of Bloomberg on a range of issues. Let's just sit on another one, EVs. What are you going to see in the next few months? Potentially some big tariffs on Chinese EVs. At the same time, what do we want? Things out of China to build EVs.
Well, yeah, because the problem is China absolutely has control of the supply chain when making a battery, when it comes to the raw materials and the processing. But whether or not it's Biden or Trump, you're not going to be able to see a Chinese EV come into the United States. Already the tariffs are north of 25%, but they're prepared to get a whole lot higher.
There needs to be a true and honest debate about electric vehicles and the cost-benefit analysis in the United States and how different it is than the cost-benefit analysis over in China. I'm not just talking about from dollars and cents, but also from global warming and emissions and all of that in terms of the production. There is a question about whether the administration is very committed to an idea that is not possible to really compete on when it comes to countering China.
Coming up, more on China. President Xi continuing his tour of Europe with stops in Serbia and Hungary. We'll catch up with Bloomberg's Andy Curran in just a moment. Equity futures on the S&P pulling back just a touch. We're negative by 0.2%. Live from New York, you're watching Bloomberg Surveillance.
Politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Equities pulling back here. We're down by 0.2% on the S&P. On the Nasdaq 100, we're down 0.2% also. Deutsche Bank just dropping this one in the inbox. Why to be positive markets? 5 reasons. Here's the 5. At a global level, data releases are looking increasingly positive across the board. For now, at least, Chairman Powell's comments and recent data seem to have taken out the near-term tail risk of rate hikes from the Fed. Number 3, oil prices are coming down once again. Number 4, the global economy has continued to prove impressively resilient to higher rates so far. And number 5, Bramo, although a few indicators are pointing in a more negative direction, this cycle has already seen several periods where the data deteriorated, but a recession didn't materialize.
Is this euphoria? Is this the euphoria that we heard about from Neil Kashkari over at the Minneapolis Fed? Is this what has driven people to keep buying risk assets even in the face of a likely weakening? We're getting earnings from Uber. We got earnings from Shopify. There is clear margin compression. There are pressures out there. People are being more selective. People are able to shrug that off, not in the specific names, but in a broader sense. It'll be just a slowdown, but not as something that more serious.
Conditioned by experience over the last year.
Correct.
That we've had so many different false dawns and head fakes where it looks like the economy's slowing and then it doesn't. And I think prime example of that is the bank intention of last spring. It's like hard landing, rate cuts coming. Nope. Not so fast. I think that's what we've ultimately got to be focused on in the global economy. In fact, the US economy more specifically. And we drew this distinction yesterday, and we've done it months previously as well. The difference between a welcome loosening in the labour market, for instance, and an unwelcome deterioration. How close are we to one and not the other?
And that's been really the divide among many people we've had on this show time and time again. There's this question of, okay, it's just enough to be a soft patch, as we heard from Tracy McMillan, or do you have the Francis Donald view of things where you're getting more protracted slowdown and suddenly the Fed could cut really significantly? If you believe that this Federal Reserve is not going to cut rates significantly, then you have to believe that the neutral rate is now north of 3 or 4% and that we are looking at the new normal. That is a new set of investing parameters, and I'm not sure whether that's truly been comprehended throughout markets.
So I think markets absorbing that message slowly. The Federal Reserve is still lagging. That long dot needs to come up based on what we're priced for in financial markets. Yields have been coming down, though. Over the last week, we've dropped about 20 basis points across the curve, the 2-year out to the 10-year. This is where yields are now. 484 on a US 2-year, up a single basis point. On a 10-year, up by 3 to 448.76. And Lisa, that follows 5 straight days of yields falling.
After getting this sort of repivot, or pivoting back to the original pivot by the Federal Reserve and with Fed speak, where people are coming out and basically saying, yeah, we don't see a likely chance of a hike. Neil Kashkari was actually completely the outlier in saying that he sees this as a likelihood. And now the question is, okay, is the bar now lowered for the Fed to cut rates if we get data that does show weaker inflation, possibly next week?
Let's talk about hikes and a potential for them. We can do that in the FX market. Let's go straight to dollar yen. Dollar yen at the moment, 155.50. That is a weaker Japanese yen in the face of this from Governor Ueda in Parliament a little bit earlier in Japan. Abrupt one-sided weak yen is negative for the economy. Said earlier, foreign exchange rates may make a significant impact on the economy and inflation. Depending on those moves, a monetary policy response might be needed.
Which you raised might be sort of a direct response to Janet Yellen and sort of her request for some greater communication and maybe, oh yeah, you guys have a lever that you can pull, which is raise rates. Maybe this is a nod to that. The market's not believing it, and that we've talked about significantly because the yen is weakening. At this point, you have to wonder what the bar is, talking about bars, what the bar is for the Bank of Japan to, or really just Japanese authorities to intervene in a market where they've already done their piece. It's had some success, but this looks like something fundamental.
This is where we missed TK, the tour guide.
Oh, yeah.
Who knew the best bar in every single city.
I knew he'd go there. He'd
every
say,
single city.
What do you say?
Tokyo. Yeah.
You, me, MH, we
Maybe
go to a
not the
Tokyo
best
bar.
Special show.
Maybe not the best
Beautiful.
bar, but the really nice one is the one from the film, where you overlook the entire Tokyo. Manhattan Bar? I think it's called the Manhattan Bar.
No idea.
New
Email
York
Tom.
bar.
Email Tom. Tom knows.
On top of the Hyatt.
He'd always try and sell a shoot, wouldn't
It's
he?
New York bar on top of the
Special
Hyatt.
He'd be like, we really need to go there. And then afterwards, he'd be serious.
Under surveillance this morning. Top stories. Less of that, more of this. The US pausing a shipment of bombs to Israel over concerns about a potential invasion of Rafah. A senior administration official telling Bloomberg that Washington hasn't made a final decision on the shipment of weapons just yet. This goes back decades, Anne-Marie. We've been talking about it, littered with examples, this relationship, the United States and Israel, of things like this happening.
It's rare, but it's not unprecedented, to your point. We've seen it with Nixon, Reagan, Obama, H.W. Bush. These kind of moments, whether it's a loan guarantee or a shipment of ammunition that have been paused. What I find very interesting is right now, according to Israeli press, Bill Burns is sitting down. He's the main negotiator representing the United States, the head of the CIA, sitting down with Netanyahu, Ron Dermer, and this comes before what also is in the Israeli press, that the war cabinet will be meeting this evening at 7:30 local time. So that's just in a few hours in Israel, and this is as the U.S. is potentially waiting for whether or not they could get this agreement over the finish line.
Going forward, I just wonder how much this is actually going to fade, as Henrietta Trace was saying, in the U.S. as a domestic issue, or how much it will be protracted. This is something that has dominated the headlines. How long does that really have to go?
Next story, out of China, BMW, lower in Germany, rising manufacturing costs weighing on profits, though the automaker did outperform its European rivals in EV sales. Meanwhile, Toyota's cautious outlook overshadowing a surge in hybrid sales that boosted profit to a record last year. China has been a key issue for sales for some of these manufacturers in the last 24 hours. Ferrari, maybe not a great example, but certainly struggling in China. Many others are facing the same experience.
Well, I'm looking at what BMW's CEO had to come out to say, saying, I would warn against doing something like that. They're talking about the subsidies that the EU is looking into when it comes to China permanently. It would do more damage to the German industry, basically saying that we should allow China to get access to a market. Why? Because they want access to China's market.
We heard exactly the same thing from Mercedes-Benz. Almost verbatim, this is what they're worried about. They're worried about the European policymakers putting up the walls and then the Chinese officials doing exactly the same thing back at them.
Because if you look at their addressable market, it's almost half of their total sales. So you are talking about companies that are designing entirely different models for the Chinese consumer. Do you know that really expensive cars, this is fascinating, BMW cars sold in China need to have a bigger backseat area because it's always a driver in the front. The driver isn't the one that's luxurious, it's the back of the car.
To be driven.
Correct.
That's why you want a Rolls Royce.
That's
not to
exactly
drive
right.
it, to be driven. TK, once again, I wonder if what the officials, what the automakers, the CEOs tell us in public is the same message that the officials receive in private. I do wonder if these Western companies, the manufacturers in Europe, in the United States, want to be able to say on the record, we don't want tariffs, we want to be able to compete fairly with Chinese automakers, they should be allowed in. China, look at us, listen to what we're saying. Then in private, they're saying something very, very different.
Basically, put up the walls, maybe that will help us sell more cars.
Precisely.
Which might be a little bit of what's going on.
You'd imagine they're pretty anxious about things. Chinese President Xi Jinping continuing his European tour with stops in Serbia and Hungary. She writing in a Hungarian newspaper that China's cooperation with Eastern Europe is a, quote, sign of the times and the general trend of development. Earlier this week, Xi making a stop in France, where Western European leaders are taking a tougher stance on trade with China. Bloomberg's Enda Curran joins us now for more. Enda, let's talk about things. I want to talk about this tour and the locations for it. France, Serbia, Hungary. It's not random. It's important. Why are those three places so significant to Xi?
It's a weighed down with symbolism. It speaks to the idea that Xi is trying to peel off the parts of Europe from the US where he can. And as you say, there were two very different messages. In Belgrade, our colleagues were reporting he landed there, and the talk was all about deepening trade, deepening economic links, deepening investment. Serbian officials saying the sky is the limit in terms of cooperation between the two countries on trade and investment. But in Paris, when he met French President Macron, even though it was obviously cordial, nonetheless, during those talks, President Xi came out and warned against prospects for a new Cold War. He warned against decoupling, and he pushed back against what he termed slurring of China or blaming third parties for any role in the Russia-Ukraine war. And EU Commission President von der Leyen also used that opportunity to push back against China over subsidies and dumping cheaper goods in world markets. So you had, President Xi trying to peel off where he can. In Paris, you had those obvious tensions over trade and investment. But in Serbia, you had a country wide open for business. And that speaks to the whole point of this trip for China.
As you mentioned, Enda, it's not just about economic development, Hungary. It's also about foreign policy. Serbia, the 25th anniversary of the NATO bombing in Yugoslavia in the late 1990s. What is the fundamental weakness that you think Xi has identified that he's looking to exploit?
It's highly symbolic that he went to the embassy on the 25th anniversary, as you mentioned, Jonathan. He made clear that China will never forget. And by the way, he has cited that NATO strike several times in speeches over the years, and some analysts interpret it as one of the reasons that they've made that alliance, so to speak, with Russia. And that does make the point that President Xi wants to pitch an alternative to the US-led security order, not just a trade and investment economic order, but he's also saying there's an alternative to the US order. And that's why they have been offering China as kind of an alternative to that, popping up in the Middle East for some talks there, arranging that no limits agreement with Russia, and now arriving in Serbia and using the embassy as an example of clearly an American mistake. So it does go beyond trade and investment. It is also about pitching China as an alternative in the global security order.
And April of last year, Macron came back from China, gave this interview to Politico, some of which Politico actually said had to be restricted and come out of the interview. And in that, he talked about strategic autonomy, not to follow the United States when it comes to Europe's relationship with China. What kind of Emmanuel Macron did Xi Jinping get this time around?
Well, this is where there seems to be inconsistency between Europe and the US, and inconsistency within Europe. I mean, President Macron was clearly pitching to President Xi an agenda of cooperation, let's work together. He was obviously pitching to China to play a role in trying to defuse or bring the Ukraine war to some kind of an end. But at the same time, of course, both Paris and Beijing used those talks to sign agreements for cooperation in AI, agreements for where they can do more trade, agreements for where they can do more people-to-people cooperation. So you do have this inconsistency, like you mentioned, Anne-Marie. You had President Macron making those comments last year that he sort of pushed back against in the end. But here we are this year, embracing each other literally and physically and talking about doing more trade and business together, but at the same time speaking for this idea that France and Europe has its own sovereignty when it comes to taking its own position on China. So it is mixed messaging, it is inconsistent. I guess the common thread in all of it is that all of these countries, while they're taking a different approach with China, they do all agree that they do certainly have their own problems and concerns when it comes to doing business with China at the same time.
How much of a win is it for that Xi is going to be also welcomed really with a red carpet welcome when it comes to Hungary?
It's clearly that, if you want to talk about where the world is dividing into blocks or where the world is perhaps taking sides, so to speak, obviously Serbia and Hungary are very open to doing business with China. The Serbian officials themselves said the sky is the limit when it comes to that. Hungary also likewise expected to give a warm welcome. And this speaks to the whole idea that China's wooing, if you want to call it, the global south, pitching itself as an alternative, as we mentioned earlier, at the same time that the US is losing ground in popular appeal. We saw that recent survey, for example, that global perception, especially in Southeast Asia, towards the US, has taken a hit over the war in Gaza. So China is using this opportunity to pitch itself and choosing those countries carefully, where it thinks it can peel them off from the US. And obviously, going to Paris and then popping to Serbia and Hungary is clearly a significant symbol in itself.
Just on the side of commerce, this question of what does China actually want this to look like? Do they want to just be able to sell cheaper goods to Europe, not if they can't do it to the US, and not have any international companies come to their own land? What's this arrangement that seems to be what Xi Jinping is lobbying for?
I think it doesn't want to be blamed for exporting cheap goods to the rest of the world. He says, I think that's part of the messaging here. They don't like this idea that some parts of the world are accusing China of overcapacity, making cheap goods and deliberately exporting them overseas. They're pushing back on that, and they're also pointing out, by the way, where they have complaints of their own, and equally where they have countries where there might be trade tensions with, for example. They're also showing, hey, there are countries here where we don't have trade tensions, where nobody's talking about decoupling. And that's why, again, Serbia is such a good example of Serbia and Hungary. In Serbia, there's talk of more investment, talk of the high-speed train infrastructure and the like. So I think China is pushing back on two fronts. They're not accepting the overcapacity allegations against it, and they're highlighting countries that are more than happy to do business with China and don't have the same complaints that some in Western Europe or the US do have.
And you are one of the best, sir. It's got to catch up, buddy. And Karen there of Bloomberg down in Washington, D.C. I thought this series of meetings over the last few days has been so important. This is a very clear message to the isolationist temptation of the American right and the American left as well, going into a big election in November. And the message is basically, if you're going to lean out, we're ready to lean in and lean in hard.
We've seen that repeatedly, actually, and that sort of message of, you know what, look, from Europe's perspective, We don't have America as our back. And from China's perspective, oh, America is sort of losing some of those ties. How can we get in the middle?
She knows exactly what he's doing here. And, you know, what's ironic about it is the fact that there's a war on European soil, and China is the reason why Putin is able to continue to fight this war, given all the materials, supplies, buying all the oil and the commodities. Yet this is Europe's #1 almost existential concern.
He wants to highlight past mistakes in foreign policy and future opportunities for the economy as well. Those locations very clearly identified for those reasons. Equity futures right now on the S&P negative by 0.1% on the S&P 500 with some stories elsewhere. Your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Shares of Uber are falling this morning by 6% in the pre-market trade. It missed on gross bookings and had weaker than expected demand in Latin America. The CFO blamed tough comps last year captured higher demand tied to the return of Carnival in Brazil. He also pointed to an earlier start to holidays like Easter and Ramadan. Yet both Lyft and DoorDash beat estimates, which brings into the fore questions over Uber's strength in the U.S. Shopify also tumbling this morning, down 17%. The e-commerce platform swung to a surprise loss in the first quarter of 21 cents a share. It also said that gross margins will decrease by about 50 basis points compared to the first quarter, and revenue is projected to be lower after the sale of its logistics business. Now, for the first time in the league's history, the WNBA is getting full-time chartered flight services. That's according to a report from the Associated Press. The commissioner said it will cost about $50 million over the next 2 years, but players have long been advocating for the change to address the safety concerns of flying commercially. Now it means no longer will they have to face long lines, bodyguards in public, clamped leg room, and layovers for professional athletes on their way to games. That's your Bloomberg Brief. John.
I feel the same way. Danny, thank you. Up next on the program, pricing in the November election.
The United States is the most insular economy of any developed world. So the fact that tariffs will go on in China, big deal.
Apparently, that conversation up next.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg.
Wednesday morning. Good morning to you. Welcome to the program. Equity futures on the S&P 500 slightly softer. We're down here by 0.1%. Going against the trend of the last 5 days. Yields have been lower. They're higher now by 2 basis points. 448.15 on a US 10-year. Under surveillance this morning, pricing in the November election.
Do I think that Donald Trump would increase tariffs to China? Sure. Do I think that would have a massive inflationary impact in the United States, I think that's ridiculous. The United States is the most insular economy of any developed world. So the fact that tariffs will go on in China, big deal. You'll hear lots of rhetoric about repealing the IRA or changing the IRA, and stocks will move on that. But at the end of the day, nothing will happen.
So that's one view. Here's the latest this morning. Traders bracing for volatility as the countdown to the US election passes the 6-month mark. CBOE's Mandy Zhu writing this. What's interesting is how early markets are embedding this election risk premium and how quickly volatility is expected to normalize post-election, with the November VIX future showing little fear of a contested election. Mandy joins us now for more. Mandy, you call this the persistent king in the VIX futures curve. Can you walk us through it?
Yeah, so we've been observing this since the beginning of the year, where the October future, VIX future, is trading at a premium to the September by about 2 to 3 points. And that's unusual because, A, we're still many, many months away from the election. If you look at this point in the 2020 cycle, there was only about a 1-point difference between the September and October contract back then. So a lot more volatility being embedded this early on in the cycle. And the second thing I mentioned before was, the November, if you look at the November future, it actually doesn't show expectations of persistent volatility. People are expecting it to be quickly resolved, which I think is, interesting given the candidates involved.
Just can you broaden out a little bit this concept of volatility? A lot of people have been saying, oh, the market's getting more volatile. We look at a lot of the overall market metrics. They're not really getting all that more volatile.
Right.
But you look at specific stocks, and they're whipsawing. We're seeing that just this morning. How do you put that together?
Actually, we have a great metric to exactly illustrate that. So this has been a key feature of the markets over the past, I would say, 18 months, is that while index volatility or macro volatility has been muted, single stock volatility has not. So if you look at the stock level, exactly to your point, there's been some wild swing at the stock and the sector level. So in other words, dispersion of stocks have been high in terms of performance, while because of the low correlation, index returns have been muted. So if you look at the VIX, that's low. If you look at our dispersion index, DSPX, that's actually near historically high levels. And that kind of exactly illustrates that dilemma.
Mandy, given we know what happened after the 2020 election, where is this conviction coming from traders to say, actually, there's little fear of a contested election?
So I think you got to separate out, because even in 2020, right, and we saw headlines about, is there election fraud, and obviously one candidate not conceding. But even in 2020, volatility came in very rapidly in November. So I think in terms of realistic path to a contested election, I think the hurdle is actually quite high. And I think that's what investors are really kind of focusing on. It's like you may get noise, you may get headlines. But at the end of the day, there is a process in place, and investors at this point still trust that process. And that's why you're not seeing that persistent kink in the curve.
You've explored this a little bit as well. How does this compare to previous elections, not just 2020, but going back even further? Is this normal?
So what it's being priced in, I would say at this point in the cycle, is higher than what we see at this point in the cycle. But if you look at how the VIX actually performs in October, it's actually underpricing relative to some of the more recent cycles. So both 2016 and 2020, we saw more significant jumps in volatility in the month of October than what is actually currently priced in. So I think 2016, 2020 averaged about 10-point increase in the VIX. So right now, 2 to 3, I think as we get closer to the election, we'll probably start to see that actually increase.
How does this stack up with what you would advocate for? So it's Steve Eisman right, basically. Tariffs on China, big deal. He said this about the Inflation Reduction Act. You might get changes. There might be talk of repealing it. We might move on that for a single day. But at the end of the day, nothing will happen. Would you advocate for the same thing? Is that how you view things?
So in terms of fiscal policy, I think what is important to focus on is that in the state of government, the state of politics nowadays, really to get fiscal policy through, you really need to have a clean sweep, right? And that's the kind of what people are focused on. And I think part of the reason why this may be a little bit less volatility being priced in relative to how it actually performed last cycle is that there's just more of a less chance of potential clean sweep by either the Democrats or the Republicans. And that's what you really need in order to enact, a significant fiscal policy in the market.
So divided government means there's going to be gridlock, but at some point they need to contend with the Trump-era tax cuts. They will expire in 2025. Do you expect some of them to be extended at the very minimum?
So I don't have an expectation in terms of the fiscal policy side, but I would say, that would obviously have an impact in terms of, the rates market, and that's where a lot of people are focusing on. But the big driver, in the rates market, obviously, is the Fed and monetary policy, and that is still front and center for a lot of investors. So we'll see as we get closer to the election, obviously the outcome of the election, what happens to those, Trump tax cuts. But so far, it's still very much focused on inflation and the Fed and potential Fed rate cuts.
Let's put a bow on things just briefly. The spike in volatility in April. Yes. You've explored this. Was it a one-off? How do you guide sort of that conversation at the moment?
Yeah, sure. So in so much as the April sell-off was driven by rates, I think it's important to recognize that the balance of risk has shifted when we talk about rates, right? We've been talking about rates higher for longer for a very long time, but now the focus is really on the longer part of that, right? How much longer, which when you think about it, it's actually vol dampening because it's talking about rates remaining unchanged for longer versus before when we were talking about rates higher for longer, the focus was very much on higher. How much higher, right? How much higher inflation can go. The right tail when it comes to the rates distribution was much more significant. So to me, what stood out in April is that even though we did get a sell-off in the market, volatility was actually really muted in the rates market. If you look at TLT implied volatility, for example, it doubled last October during the rate sell-off. But this time around, it actually went up very, very modestly, and now actually currently back down to a one-year low. So the more contained reaction that we're seeing in the bond market, I think, has spilled over to the equities, and that's why VIX is again back to 13 handle.
Interesting, Mandy. You're one of the best at this, and we always enjoy catching up with you. Thanks for being with us.
Thank you,
Mandy Zhu there of SIBO, going through some of the Fed talk at the end of that conversation. The emphasis at the moment on time. The lineup for the Fed speak: Vice Chair Jefferson a little bit later. You'll hear from Fed Governor Cook. And you'll hear from Boston Fed President Collins as well. You'll hear from many more Fed officials throughout the week. Coming up on this program in the next hour, we'll catch up with Christian Mamani of Lafayette College, Bloomberg's Craig Trudell, Kathy Jones of Charles Schwab, and Citi's Scott Kroner. I'm very interested in the car conversation with Craig, Lisa, in the next hour. Some of these automakers all struggling with the same thing.
Are they going to basically argue for no tariffs because that will embolden their chances in China? Or do they see that as a path to their success?
That conversation just around the corner. Futures right now, negative by 0.2% on the S&P, just a little bit softer, coming off the back of 4 days of gains. From New York City, this is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute. And what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Everything's pointing green for the Fed to start cutting rates here.
This year maybe has 1 or 2 rate cuts in it.
When you're the Federal Reserve, once you start cutting rates, can you stop? And the market's, if you like, not convinced.
It doesn't really matter because even if they cut, they're only cutting a little bit.
Our expectation is that rates stay where they are, potentially a cut at the end of the year, and that's supportive for markets.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Krishna comes into the studio. Be careful. You might get what you want and you might not like it. That's a start to a conversation. From New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance begins right now with equity futures negative by 0.2% on the S&P 500, following 4 days of gains on the S&P and 5 days of 10-year Treasury yields falling. Yields a little bit higher in the session today. Coming up this hour, through the next 60 minutes or so, we'll be catching up with Krishna Mamani of Lafayette College on sticky inflation, Bloomberg's Craig Trudell on earnings from global automakers, Kathy Jones of Charles Schwab on the rebalancing in the labor market. Looking forward to that conversation a little bit later this hour. We begin with a big issue, stock staging a May comeback fueled by rate cut bets and strong earnings. Krishna Mamani of Lafayette College saying this: both the FOMC meeting and the last employment report were positive for asset prices, but it does not change the challenge the Fed faces. Inflation, which is what matters for the Fed, is sticky. So the net outlook is still the same. The Fed wants to cut, but won't find the opening in the near term. Krishna's with us now for more. Krishna, good morning.
Morning.
Careful what you wish for. Is that the message?
Well, so if you look at the FOMC presser, I think Chair Powell made it amply clear that the way they are thinking about risk is the upside to inflation is pretty limited, so the upside to rates is pretty limited. What they have to kind of contemplate is when do they actually cut. So I think the direction of policy is really set, and when the employment report comes out and you see a market rally, I have to ask myself, do I like that situation better than liking what the FOMC presser situation was, which is capped rates, growth good, as opposed to capped rates, maybe cuts, but economy slowing down significantly. If I have a choice, I prefer the first one rather than the later scenario. If you think about it from the Fed's perspective, I think inflation going up or stagflation or any of those things are really not their significant or biggest concerns at the moment. What their biggest concern is, if things go south, how fast do they go south and what do we really do? That's what they're focused on, and that's what they have communicated to us.
Let's build on what you just said. Let's unpack that. So you divided last week between a post-Fed world and a post-payrolls world, and you said which one you'd like if you could choose. We don't get to choose. Which one do you think we've got?
I think we still got the post-FOMC presser world. I think the employment slowdown, it's kind of payback for previous strength. But at the same time, it is important to recognize that the labor markets are rationalizing, and therefore we probably don't see the sort of growth that we had before. But there's enough stimulus that was kind of put into the system that is still going through the system. And if you look at what happened to inventories in the last GDP report, I think that alone probably gives you another 0.5 percentage point in growth terms. So if you look at Atlanta Fed GDP now, we are talking a 3 handle. So things are not slowing down, and I think that's why the FOMC scenario probably holds, even if we see a couple of weaker employment reports.
Is this another way of saying that essentially a post-FOMC meeting kind of world is one in which people are depending on humans, and they're depending on judgment calls, and they're not quite as data dependent as the Fed says that they are?
Well, so yes, but at the same time, it is worth recognizing that the data is actually supporting the human dependency. That is, if the data came in and we saw an employment report of 50,000, I think that scenario would be dramatically different. And if that 50,000 came after 200,000 or 250,000, we would freak out a lot more. So I think we are data dependent. It's just that the data is very consistent and not slowing down.
You've been really good about T-bill and chill and talking about why you think that's still a good place to be. Do you still think that, or do you think the strength, the persistency to that, and the belief that we're eventually going to get some sort of cut is enough to start maybe broadening out to, long duration and chill or something else?
Yes, I think at some point there'll be a time to buy long duration. Whether that is today is really the question. And the reason for T-bill and chill is really that the equity market is not correcting in a big way because nominal growth is still relatively solid. Earnings growth is pretty decent. So that's, the growth picture is not going to be a driver for equity markets on the downside. On the other hand, equity markets, given valuations and given kind of the dispersion of returns in certain sectors as opposed to broad-based return profile, I think kind of ensures that it can't really run away from you. So there's really, in an environment where you're getting 5.5% in T-bills, why take that risk when the upside or downside is pretty limited?
Are you saying that the idea of a broadening out in the rally is flawed if rates are where they are?
I think we would like broadening out in the rally, but it is really not happening to the extent that we would like. So, if you look at post-employment report market reaction, what did well? Tech. So that really has been the primary driver. And until kind of the profile of the market changes dramatically, the likelihood that you get another 30% return out of tech that gets you up 10% in S&P, I just don't see that happening.
Given how the market is reacting to this level of rates, do you agree with the Fed that we are sufficiently restrictive?
I think so. I mean, if you look at any metric like Taylor rule and things like that, I think things are restrictive. I think another thing to kind of remember that the inversion of the curve itself ends up being restrictive from a credit creation perspective. That is, if your funding cost is 5.5% and you can lend out at 4.5%, the likelihood that the banking sector will probably go out and create a lot of credit, a long-term credit, is not possible. So I think it's restrictive. It's, could it be more restrictive? Yes, but if it is a lot more restrictive, then the risk of a recession becomes significantly higher, and that's what kind of worries the Fed far more than whether inflation can persist for another 6 months or not.
Can we build on that just a little bit more, the importance of the banking channel? Because if we were sat here last spring, we would have said what's about to happen is going to send this economy into recession. But Michael, good friend of ours, yours too, sat in your chair just last week, and he talked about the importance of credit markets, private credit, really picking up things off the back of a banking sector that maybe struggles just a little bit given the forces you've just described. How important is the bank lending channel to the broader economy?
Well, so I think the private credit market is important for the financial economy far more than the real economy. That would be my sense. I think if the banking channel is still very important. The size of assets in the banking sector as opposed to private credit, I mean, these are orders of magnitude different. So yes, the private credit certainly helps with respect to valuations and financial assets because of financing costs and things like that. But at the end of the day, what happens in the real estate market, what happens in SME sectors, it's really driven far more by banking. I think irrespective of how large the private credit market gets, the impact of that in the overall economy is still going to be relatively small for some time.
I'll try and read Lisa's mind then. So is the senior loan officer opinion survey still relevant?
Absolutely, absolutely. And I think the Fed pays a lot of attention to that. I think that's their benchmark about how people are feeling and what's the direction of credit creation in the market.
Although that's the reason why people have been basically paying attention to this, but why we have not seen the kind of weakness that we would expect to see, because so many people do not any longer rely on that bank lending in the same kind of way. I wonder, do you think that this market has fully adapted to rates where they are? And I understand the mortgage market is separate, but aside from that, that corporate America has largely adjusted to rates.
Well, so let's talk about two different issues. One is, did the rate sensitivity of U.S. economy go down because of sustained low level of rates for an extended period of time? Absolutely. And therefore, the rate sensitivity today is going to be meaningfully lower than what it was in 90s or early 2000s and those time periods. But having said that, though, I think at this level of rates and an inverted curve, saying that there is, there's no impact of high level of rates in the market, including mortgages, I think it's not as large, but it is still a driver of investment decisions and things like that. If there wasn't enough stimulus, so if we kind of, analytically, if you analyze it, you have to kind of strip out what the impact of stimulus and the fiscal policy really has been on growth. And if you do that, I think you'll find rate sensitivity lower, but it's still significant.
Going into later this year, you talk about the fiscal side, and I know that Emory has been focused very much on the question around fiscal stimulus, what happens with the tax cuts that might get extended next year, tariffs that might come in. How much are you factoring that in at a time where a lot of people are saying that could have a meaningful impact on where the rate structure is, and also just in general on the deficit?
Yeah, so I think the fiscal policy is going to be important, and I'll make a couple of points with respect to that. That is, the disbursements are still going through the system. The fact that it was passed doesn't mean that it got disbursed. So I think that ends up being supportive for a little while longer, and perhaps even in early 2025. Having said that, my judgment would be that the likelihood that in the future, given the state of the economy, deficit, inflation, everything, that we get the same level of fiscal impulse in the economy, that I have a great deal of difficulty accepting that premise. I think it's probably going to be lower than what we have experienced over the last 5 years.
So base case, what do you put? Just an extension of some tax cuts, and that's really it?
I think if there is an extension of tax cuts, it'll have to be after a big fight and a tough slog, rather than it happening naturally as it would have happened without the inflationary episode.
Krishna, this was awesome on markets, on maturity transformation. Krishna Mamani of Lafayette College. Krishna, thank you, sir.
Thank you.
The latest on Tesla. Let's get to the stock in the pre-market. Just a little bit softer, negative down in the pre-market by something like 3%. Report from Reuters. I'll read it verbatim. The lead paragraph reads as follows. U.S. prosecutors are examining whether Tesla committed securities or wire fraud by misleading investors and consumers about its electric vehicles' self-driving capabilities. This according to 3 people familiar with the matter. That stock, at least for now, Lisa, down about 3%.
Honestly, just the hits keep on coming. This is not necessarily related to Elon Musk. This is having to do with the steering, braking, and lane changes and sort of what sort of self-driving systems were overseeing them. This is going to be pertinent, especially as they try to shift into robo-taxis and the like.
We'll stay on top of that story, just a little bit softer in the pre-market at the moment. Let's get you an update on stories elsewhere. Here is your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. President Biden will champion a major tech investment in Wisconsin today, which of course is a swing state. He'll be joined by Microsoft President Brad Smith, who will be announcing a $3.3 billion plan for an AI data center. The facility will be built on land that had been picked to become a Foxconn plant during the Trump administration. Foxconn then scaled back plans, creating just 1,000 out of the 13,000 jobs once expected. And TikTok's parent company ByteDance is taking the U.S. government to court. The China-based company claimed a divest or ban law violates the First Amendment. ByteDance had until January 19th to sell or face a ban if the courts do not intervene. And Intel has issued a warning in a new filing. The chipmaker expects revenue to fall below the midpoint of its estimate for the second quarter. The company, however, did not change its guidance, which is currently $12.5 to $13.5 billion. The news also comes as the U.S. Department of Commerce revoked some export licenses. Under the measure, companies like Intel, Qualcomm, and other won't be able to sell to China's Huawei. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Much more from Danny in about 30 minutes' time. Up next on the program, we'll get you some morning calls. Plus, Rivian falling short on earnings as it looks to boost EV output. We'll be talking to Craig Trudell of Bloomberg about the latest for the automakers. Rivian's down by close to 7%. And the latest on Tesla, this from Reuters. U.S. prosecutors examining whether Tesla committed fraud. The stock a little bit lower in early trading as well. From New York, this is Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
4 days of gains on the S&P 500 coming into Wednesday, pulling back just a little bit. We're down here by 1/3 of 1% on the S&P. Time now for some morning calls. First up, JP Morgan lowering its price target on Disney to 135, keeping an overweight rating on the stock. The analyst saying Disney's streaming additions and direct-to-consumer profitability are underappreciated positives. Next up, Barclays raising its price target on Lyft to 20, sticking with an equal rate rating. The analyst citing a jump in gross bookings, seeing no signs of consumer weakness. And finally, Mizuho lowering its price target on Rivian to $11, maintaining a neutral rating. The analyst Vijay Rakesh noting the EV maker's strong product roadmap as investors await its low-cost model. On the EVs and a whole lot more, let's get to Bloomberg's Craig Trudell. Craig, I want to go straight to this story from Reuters just moments ago. The lead paragraph that prosecutors are examining whether Tesla committed securities or wire fraud by misleading investors and consumers about its electric vehicle's self-driving capabilities. This according to 3 people familiar with the matter. The stock is a little bit lower in the pre-market. Craig, from your perspective, how much more does this push the story forward? How much more is here that we didn't know already?
Without disrespecting Reuters, I would say honestly not a whole lot. I think this is something that we reported in late 2022. It's something we reported again in early 2023 when we reported that Elon Musk himself played a very hands-on role in this sort of infamous video where Tesla had a questionable disclaimer about this idea that the car you're about to see is driving itself. It wasn't actually, driving itself. I think, Tesla actually has acknowledged in its securities filings that the Justice Department has sent information requests, which is another way of saying subpoenas. So I think this is something that's been known and a known risk for Tesla, and this story doesn't necessarily unearth new details to flesh that out.
Craig, as you know, and Reuters alludes to this in this piece, ultimately Tesla has warned drivers to stay ready to take over driving. What do you think the ultimate remedy for all of this will be?
I mean, I do think that this, again, draws attention to this idea that for years now they've been selling a product called full self-driving, which is not self-driving fully or otherwise. It is a system that you, the human, are responsible for the car. When you crash using the system, you run the risk of Tesla, going to court and pushing back against you trying to sort of, have the manufacturer take responsibility. And this is becoming all the more relevant just given the amount of leaning in that we're seeing Musk do into the self-driving story, because I think he feels like that is a part of what Tesla brings to the market that other manufacturers don't. I do think that it's a fair question, however, to raise as to whether or not he's overstepped in terms of what he's claimed about his technology and what it's capable of.
And what about the robo-taxis? I mean, we heard that that's going to be coming later this year. Does that call this into question?
Yeah, I think the robo-taxi has been sort of on the drawing board going back to 2016. It's remained on the drawing board. We'll see in August just how far along the company is. And I think there are real questions about, whether or not you can take a sort of iterative approach to, a driver assistance system that becomes, gradually more capable. I think you have to make a real serious leap from a system that is monitored and supervised by a human at all times to one in which there in some cases wouldn't be anyone in the driver's seat. That's a huge leap that other companies have come to grips with, and I don't think Elon Musk necessarily has.
Well, speaking of the robo-taxis, you have the China Daily actually today talking about the fact that Musk proposed to launch them in China. Is this why he's doing it? Because of all the regulatory concerns he's dealing with in the United States?
I think this would be a test vehicle, experiment in China, which is by no means unprecedented or something that is even something that we've seen now going back to, I would say, 2015, 2016 timeframe, where it's a big difference, again, between, testing this technology with a human behind the wheel to take over in the event that, the system struggles with an intersection or is potentially going in to crash into something. You can call that a self-driving test, pilot, but it is a whole nother thing entirely to actually take the human out of the driver's seat. We've seen companies do this, in Waymo and Cruise, but we've also seen these companies, get into, really troubling issues with this technology. Cruise late last year having, a really sort of grisly incident where a pedestrian was hit, run over and dragged, and, the company's handling of that, it's still coming back from that. And so, you take that example, you take Uber as an example, going back even further, where a pedestrian was killed in Arizona, and boom, authorities in that state took its cars off the road.
You mentioned Uber. The stock is down pretty hard in the pre-market. We've got lots of earnings today, Craig, not just from Uber. That stock, by the way, down by 7.6%. Also heard from the likes of BMW, the likes of Toyota in the last 24 hours. I think Ferrari yesterday too. What's the takeaway, Craig, from the big automakers over the last day or so?
I mean, I think it's universally just really tough sledding in the sense that nobody is really lighting the world on fire. Maybe the one exception being Toyota, which had a really incredible result for the last fiscal year, but as is typical for Toyota, they're very conservative about the year ahead. And so, I think they see operating profit, dropping this fiscal year. We'll see whether that's just sort of typical Toyota conservatism or a reflection of just how challenging things have gotten. But we've seen BMW earnings, a bit light. I think Mercedes is also talking, today about the idea that they expect to sell combustion engine vehicles for longer than previously anticipated. I think, Ferrari, Porsche have flagged real weakness in China. So, you want to talk about sort of reasons to be sort of a bit, incrementally bearish or cautious about the idea that this has gone from an environment of, having more demand than you can keep up with it as a manufacturer to maybe struggling a little bit for that incremental sale. That's where we're at
yeah, I'm sure they want to go back to those 2020 challenges where they just couldn't make them quick enough. That's not where we are. Craig, as you know, it's so difficult to have the right product at the right time, at the right place available for consumers. Toyota seem to have nailed that with the hybrids. I just want to roll things forward just a little bit and maybe reel you into a conversation about politics if I can, but don't be too worried. I want to understand what automakers are saying publicly in Europe about the prospect of tariffs going on Chinese EVs and what we suspect they might be saying privately to European officials.
Yeah, it's a really interesting story and something that's coming up just this week as a lot of executives are in town for a Financial Times conference, related to the future of the car. I think, we sat down with the COO of Hyundai, who just, went to Beijing for the car show that happened last month, and I think was really sort of blown away by what he saw there in terms of the progress that the Chinese manufacturers have made. And he said, he told me yesterday, they want to dominate. They want to come here to Europe and really have big ambitions. And he specifically flagged BYD, which of course has dominated in China of late, and MG, which is a British brand that was, bought out of administration by a state-owned car maker that has really caught on both here in the UK and Europe broadly, and in large part because, it's a brand that people recognize. They think it's British, even if it's under Chinese ownership now. I think these companies absolutely can compete, and there's a real question of whether or not, they'll still be competitive even in the event of higher tariffs that are aimed at trying to level the playing field.
Interesting, Craig. Thank you, sir. Craig Trudell with the update out of London. They want to dominate. European officials, US officials, American officials, the US president, going to be able to stop them?
Well, this is the question, because when it comes to Europe, when you listen to the likes of BYD, not only do they want to set up factories in Europe, Jonathan, they want 5% of the market share when it comes to Europe. And I look at the BMW CEO today. I would warn against doing something that's permanent. We can end up quickly shooting ourselves in the foot.
Yep, I think we get that message loud and clear. Tesla, by the way, down by 3.5%. Equity futures down about 1/3%. Coming up next on the program, we'll catch up with Kathy Jones of Charles Schwab, weighing in on the rebalancing of the labor market. That's just around the corner from New York. This is Bloomberg.
politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
We're 60 minutes away from the opening bell. Going into that opening bell, following 4 days of gains on the S&P 500, incidentally, the longest winning streak going back to the middle of March. Equity futures are a bit softer here, negative by 0.4%. On the Nasdaq 100, we're down by 0.5. On the Russell, which has performed quite tremendously over the last 5 days, that pulls back too by 0.9%. In the bond market, we can talk about some supply. Bramo's super excited about all of that. Going to get some 10-year bonds a little bit later, $42 billion worth. Tomorrow, $25 billion worth of 30-year bonds. Going into it, we've rallied, and rallied quite hard over the last 5 days. Yields have been falling before today by more than 20 basis points across the curve on both a 2-year and a 10-year. The 2 years at about 483.65. Bear in mind where we were post-ECI last Tuesday. The employment cost index came in just a little bit hotter than expected, and we were looking at 5% plus at the front end of the curve. We've come all the way back down. On a 10-year, 448.15 is where we are at the moment. We're up by 2 basis points. Tons of Fed speak today. You'll hear from Vice Chair Jefferson, Governor Cook, and Boston Fed President Collins as well. That sets you up for more Fed speak into Thursday and into Friday. Let's switch to the board and go to foreign exchange. I just want to sit on the politics of dollar-yen, because the politics of dollar-yen is maybe more interesting than the economics of the Japanese economy at the moment. 155.57 on dollar-yen. So once again, a weaker Japanese yen, that currency pair moving by about 0.6%. The message coming out of Japan is the same, but the language that's being used has changed, and they're starting to lean towards maybe the prospect of doing something with monetary policy.
But it's not working. We've only really seen it work is when they actually intervened into the market. But you and Lisa brought up a great point earlier, which is the fact that maybe this is Japan having something to say after we had remarks from the Treasury Secretary, who said, well, actually, if this were to happen, the Bank of Japan or the Treasury, the Finance Department of Japan, should actually be consulting with some of their G7 partners, notably the United States. And she actually called that at the moment just rumors that they intervene. Potentially a little bit of shade thrown from the Treasury Secretary to Tokyo, and then this was their response.
It just reminds me of something that happened with President Draghi maybe 10 years ago, when they used to talk about the exchange rate in Europe, and they would always say, it's not a target. We don't target the euro, we don't target the exchange rate, but the FX channel is important for price stability. And I think this is where Governor Wader was going, speaking in Parliament. Foreign exchange rates make a significant impact on the economy and inflation. Depending on those moves, a monetary policy response might be needed. Of course, this is reverse engineering what we heard from Draghi 10 years ago, because he wanted a weaker currency, and clearly at the moment, some of the Japanese officials want a stronger one. Under surveillance this morning, elsewhere, the United States pausing arms shipments to Israel. Senior White House officials telling Bloomberg that the president is still concerned about a possible invasion of the Gazan city of Rafah. The US has not made a final decision on whether to proceed with the shipment. Prime Minister Benjamin Netanyahu's office so far, Anne-Marie, declined to comment.
Right, so this is a pause, not an outright suspension yet. I think what the U.S. is waiting on is pretending to see what kind of invasion Israel may be planning. Right now, it's just that they captured that border crossing. And two, what's going on with the hostage negotiations? Bill Burns is currently the CIA director, the lead negotiator on the U.S. side, is currently in Israel. He's sitting down with Netanyahu, Ron Dermer, and then we're going to have the War Cabinet meet this evening, Jonathan. And from there, potentially, we could see the direction of travel for what comes next.
You can see what the President of the United States and this U.S. administration is worried about. We're talking about a very dense urban area, populated by more than 1 million Palestinians. And at the same time, you've got a delivery that's set to take place of 3,500 bombs from the United States of America. 3,500 bombs set to be delivered at a time when the Israeli government is talking about going into Rafah. You can see why this would be deeply unpopular in the United States of America, given the devastation that's already happened in that part of the world and could continue to happen in the weeks, months, and maybe even years to come.
Absolutely. And when the President of the United States is saying he does not want to see a full-blown invasion of Rafah, or really even any invasion of Rafah, even though we heard from the State Department saying that they have put proposals on the table. And Jonathan, you brought this up a number of times today. It is not unprecedented for an American president to be in this situation with Israel, even though it is rare. It doesn't happen all the time, especially when they talk about this ironclad commitment the U.S. has to Israel. Former President Obama delayed deliveries of missiles in 2014. Reagan halted a shipment of a type of artillery shell in 1982. Nixon held off on arms in 1973, and George H.W. Bush withheld loan guarantees in the early 1990s.
There's a deep history there. That's the latest on the Middle East. Here's the latest on TikTok. Taking the U.S. government to court. Widely expected, not surprising. The parent company, ByteDance, is suing over the new U.S. divest or ban law. The company claiming it violates the First Amendment. ByteDance has until January 19th to sell TikTok or face a ban unless courts intervene. This was widely expected, and ultimately, this is going to take a whole lot longer.
Whole lot longer, because also likely what's going to happen is the President of the United States is also going to extend that deadline to even 90 days. So this will firmly be in the hands of the next administration, whether that's Biden 2.0 or Trump 2.0, they'll have to deal with it. What TikTok is going to do is they're going to say this violates the U.S. Constitution, free speech. Also, Jonathan, some of their other arguments include it will hurt millions of small business owners who use the platform. They're really going to try to come at this from every angle possible. And I mean, the irony is not lost on you and I.
Shouldn't be.
When you look at how the Chinese government treats U.S. social media.
We've got to draw a distinction between ability and willingness. Clearly, this administration is willing to do something about these issues. Ability is a very different thing. Are they able to do anything about this? And can Chinese companies continue to use the U.S. system against itself?
Well, we'll have to see. This is going to come down to national security concerns. Does the U.S. potentially have to even show some concerns, some intel that right now is secure and they haven't been showing to the broader public? Will they have to potentially start opening up some of these books that, you know, you hear about, that they're briefing congressmen and women about? Potentially we'll hear about that. But Jonathan, I also go back to the fact that Rupert Murdoch became a U.S. citizen so he can buy the remainder of Fox. There is a reason why, for certain networks, you have to be an American citizen. They don't want this in the hands of adversaries.
This is the latest on TikTok. Here's the latest elsewhere. Minneapolis Fed President Neil Kashkari saying it's too soon to know if inflation progress has stalled. Kashkari telling the team here at Bloomberg, Carol Massa, Romain Bostic, that, quote, we're in a good place right now. The labour market is still strong. We can take our time to get more data to see if disinflation is going to continue. The Fed speak will continue today with Jefferson, Collins, and Cook on deck, and a whole lot more still to come this week. Kathy Jones at Charles Schwab joins us now for more. Kathy, good morning to you. It's good to see you.
Good morning. Thanks for having me.
What are you expecting to hear from these Fed officials over the next few days?
Same old thing, patience. We're on hold. Things may or may not be moving in the right direction. We think they're moving in the right direction, and we're going to stay on hold for the time being and get more data.
You've got a different view on the data. Was the Q1 hot economy a bit of a head fake?
Yeah, the domestic demand numbers in Q1 were good, like 3.1%. That's where we've been for the last couple of quarters. But the employment data actually with the revisions and with the latest numbers were a little bit softer, I think, than people might realize. So not only was the payroll number last month below trend, we had some downward revisions. The work week was down. And we're seeing wage growth edge down a little bit. And you put all that together and aggregate income may not be as strong going into the next several months as it has been over the past 6 months.
I know we were super eager to get to the weekend on Friday after payrolls, but the ISM services number was terrible. Going through the details of it, first contraction since 22, below all estimates in our survey here at Bloomberg, business activity slumping to a 4-year low, input costs growing in the wrong direction. What did you take away from that? How much weight do you put on a PMI like the one we got on Friday?
Yeah, I don't overweight it. I don't make it a real heavy part of my analysis, just because some of those surveys are diffusion indexes, so they kind of come and go. They're lumpy sometimes. But it wasn't good news, and I'm less worried about the price index as I am about the overall direction of trend in terms of activity, because I think that's probably a better read than the price index is.
What we've been trying to establish, and we've been talking about on this program around this table for the last few hours, the last couple of days, the difference between a welcome cooling and an unwelcome deterioration. What's the line in the sand for you? How do you draw a distinction between the two things?
Yeah, it's the job market. If we start to see a big deterioration in job creation, a rise in the unemployment rate, or a real tailing off in terms of the aggregate hours worked, the work week earnings, that kind of thing, then I'd be concerned, because that would signal to me things are moving pretty quickly, and the labor market can do that. It can move pretty quickly.
How difficult is it to really understand this labor market when we have an incredible amount of immigration into this country? And also, when you look at the survey response rate, it's actually quite low.
Yeah, it's been a real problem. And the survey response rate has been going down over the years, but post-pandemic, it is really, really low. And I think we can expect a lot of revisions to the data based on that. Usually get revisions anyway because they get more data over the course of a couple of months. But in this case, it's even more likely to see some substantial revisions. And post-pandemic, everything's kind of thrown off anyway. In terms of the data, the seasonal adjustment factors haven't been working well. You know, you name it. So yeah, it is less reliable than it's been in the past, but it's what we have.
And how do you view this labor market really being able to handle all the immigration that has flown into the United States? Is there basically a lineup in terms of the workers coming in with the jobs the U.S. economy needs?
Yeah, I'm sure there's some mismatch, but the truth is that a lot of the jobs that we need are lower level, service sector jobs, healthcare in particular. We need people in nursing homes and daycare centers and, in these places. So a lot of these are lower wage jobs. A lot of immigrants come in and are willing to take lower wage jobs, even if they have more education and might qualify for something else. They do that because they need to work. And so I think, to tell you the truth, I don't think it's a huge mismatch. I don't think that this is a big problem for the economy. I think it's a big help to the economy to have people filling these jobs that are difficult to fill.
When John talks about the line of cooling versus serious deterioration, what are you looking at in terms of the Fed needs to see in the labor market in order to make that move of the first cut? Is it a 4.2% unemployment rate, or is it higher?
Yeah, I think 4.2 would really start to get them seriously considering the timing of the first rate cut, because we have come up from 3.4 at the low, 3.5 at the low, long period over 2 years under 4%. We tick above 4.2. If the other data are also soft, corroborating that rise in the unemployment rate, I think that would get them pretty seriously moving.
We've had questions about whether the rest of the world needs the Federal Reserve to cut so they can cut. The rest of the world's not waiting around. So we've heard from Sweden, they've cut. That follows the S&P. They've done the same thing. Citi's Andrew Hollenhorst says this morning: the Fed is unlikely to buck the global cutting cycle. Goes on to say that if either US inflation or activity slows, the growing rate differential between the US and other countries is yet another marginal factor that would encourage the Fed to follow the global trend towards lower rates. How does one inform the other?
Yeah, I mean, it's through the foreign exchange channel, right? We've had a very strong dollar. A lot of it has been driven by that widening rate differential. And so the dollar was starting to come down a little bit when we thought the Fed was going to cut, and we were building in 6 cuts. And then it took off again after the Fed sort of extended that timeline. And we see the pressure on the Japanese yen as a potentially destabilizing factor. We know Japan isn't too happy about it. So all these factors, I would say the dollar's on the margin for the Fed, but it's there, and widening rate differentials can create their own set of problems.
So you've gone through the framework for thinking about the economy, the global economy, and central bank decisions. Let's talk about the menu. A 2-year at 483, a 10-year at 448, a 30-year at 462. What do you want to buy?
So we've been talking about extending duration for quite some time throughout this whole kind of upturn in yields. And the reason is beyond just sort of locking in yield for the future and getting those cash flows. And we do think the economy slows, inflation continues to fall. But also the upside downside risk reward is pretty attractive. When you have coupons at 4.5% to 5.5%, you know, the amount that rates have to jump in order to actually have a negative return is very high. If you just sit there, you're going to earn the coupon. If they go down, you're going to have, you know, that capital gain kick in. So when we look at that in terms of managing portfolios, the upside downside really favors being a little bit more duration.
Are clients still holding on to money market funds? Are they listening? What would it take to unlock that?
Yeah, they're gradually moving out. But I do think, yeah, there's I think if you get the yields below 5%, we'll start to see people sort of migrate out. But right now, the short end is very comfortable. You know, you can sit there for a long time and just, you know, earn the interest.
It's why Chris Mamali was sat around this table talking about T-bills and chill. Still, Kathy Jones of Charles Schwab. Kathy, good to see you. As always, great to catch up. Thanks, Kathy. Let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Tesla shares are falling in the pre-market 3.7%. Reuters reporting that U.S. prosecutors are looking into whether Tesla committed securities or wire fraud by misleading the public about self-driving capabilities of its EVs. Tesla's autopilot systems assist drivers with steering, braking, and lane changes, but are not fully autonomous. The DOJ is examining statements by the company and Elon Musk that suggest its cars can drive themselves. Shares of Uber also down in the pre-market, 8.7%. The ride-sharing app missed on gross bookings and reported weaker than expected demand in LATAM. Uber CFO blamed tough comps, saying that last year captured higher demand tied to the return of Carnival in Brazil. He also pointed to earlier starts to holidays like Easter and Ramadan. Yet, both Lyft and DoorDash beat estimates, bringing to the fore questions about the strength of Uber and their market share in the U.S. Now, Panera Bread will no longer be selling its caffeinated charged sips drinks. The drinks, which infamously included an ultra-caffeinated lemonade, were the subject of at least 3 lawsuits, claiming that people who drank them were harmed or even killed. The drinks have up to 390 milligrams of caffeine per 30 ounces, which is about 4 times the amount of caffeine in a cup of coffee. Instead, Panera said it's going to introduce new beverages in the next 2 weeks, like a blueberry lavender lemonade. That's your brief, John.
Danny, thank you. If anyone out there has had one of those, can you reach out and let me know what it tasted like? Can I just go through those numbers again? Up to 390 milligrams of caffeine per 30 ounces, about 4 times the amount of caffeine in a cup of coffee. Have you ever had one of these?
No, but it sounds like Tom's Tang.
Absolutely ridiculous. Up next on the program, following the euphoria.
It is a relative game that we exist in, right? So certainly growth in stocks and equities have outperformed. And you want to own that growth in my mind.
We'll talk about some of the opportunities next in the equity market with equity futures near session lows. We're down about 0.4%. Going into the opening bell about 44 minutes away. From New York, this is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
Let's get you the scores going into the opening bell. That cash open 42 minutes away. Equity futures pulling back by 0.4% on the S&P. Following 4 days of gains, just a slight pullback. Yields a little bit higher by 3 basis points, 4.4876 on a US 10-year. Under surveillance this morning following the euphoria.
It is a relative game that we exist in, right? So certainly growth in stocks and equities have outperformed. And you want to own that growth in my mind. So there's always going to be opportunities. U.S. exceptionalism, it's making its way through the U.S. stock market. And I think that can be somewhat sustainable.
Here's the latest this morning. Stocks staging a comeback after an April slump. Sentiment indicators at 2 major banks faltering after that pullback. Citi's Lefkovich index exiting euphoria territory, bringing a risk-reward setup to clearly bullish levels, according to Managing Director Scott Kroner. I'm so pleased to say that Scott is with us now for more, going into the opening bell. So, Scott, let's get to it. Your outlook, constructive with complications. Can we start with the complications?
Sure. The complications are that as constructive as we are in the fundamental setup for the S&P 500, we still have a number of macro overhangs and issues to contend with. Views of the pent-up effect of Fed rate hikes to this point weighing on economic activity and ultimately translating through to fundamentals. Obviously, where we are with the interest rate setup and influence on stocks, all of which gives us pause, but in a context here where we're increasingly constructive on the fundamental setup for the S&P 5 as we head into the back half of 2024.
That's the fundamental setup. Can we just talk about sentiment, which you allude to in that line that I read out aloud? Scott, where's sentiment now?
Yeah, so sentiment is always part of the puzzle, if you will. And as it turns out, our Lefkovich index, which is our go-to sentiment read, had moved into euphoria right at the end of Q1. And in a pretty quick reversal versus history, it's come back out as we've moved through the bulk of the Q1 reporting period. So we're back in what we'd call a higher end of neutral, but you've taken some of that euphoria out of the circumstance. At the same time, what I'd emphasize here, Jonathan, is that when we use the sentiment indicator, it's usually in the context of other indicators. And our implied growth work also tells us that you've gone from a level headed into the Q1 reporting period that was going to be tough for corporates to surpass to something that also is more reasonable at this point in time as we move through the reporting period itself.
So some people, as you know, have been pushing back against earnings expectations, including your peer, Marko Kolanovic, over at JP Morgan. Could you just walk us through, just give us some insight into where earnings expectations are now and how they've evolved through the year so far?
Well, so we're at 245 full year for the S&P. We've been at that level, honestly, since last July. So we feel like as if our top-down sector-driven models have done pretty well for us. Consensus has moved up. We're right around 243, 244 right now. The way the Q1 reporting period set up was that we got a pretty clear beat, but a hold dynamic where your full-year consensus numbers did not move much. Now, this is not uncommon. It's very typical to see expectations come down into the reporting period, followed by a decent positive surprise. But the setup here, given what we know about the economic condition right now, is that we ought to begin to continue to see that consensus number lift marginally as we go into the Q2, Q3 timeframes.
And this is what I want to build on, the shifts in earnings that you anticipate later on this year and what that could mean for the big debate, I think, of the last 12 months, which has been large versus small and everyone itching for small to work. And then you get a series of head fakes after head fakes, and then small caps get hammered again. Scott, what's it going to take to get that more durable, sustainable shift away from large cap growth towards small caps?
Well, I think it's going to happen as a function of the numbers, right? So again, if you look at the setup here over the past year, your mega cap growth cohort, called the Mag 7, has seen their 2024 earnings expectations rise by roughly 28%. The other 493 within the S&P down 8%. Okay, we've seen some flattening in that other 493 number. And the setup, if you look at just the way the progressions go by sector, is that we should mechanically begin to see improvement as we go into the back half of the year. So we're looking for a broadening effect. We have been for some time now, fundamentally, that should augment what's been happening on the price side already. Now, here's where it gets interesting. We've been kind of coming at it from a Mag 7 versus other 493. We've also come at it from a sector perspective. But if you look at small versus large and value versus growth, The setup right now, as we turn the corner on mid-year 24, begin to look at 2025, should be a narrowing in earnings growth between those cohorts. So what you get here is a gradually improving fundamental setup in favor of small versus large and value versus growth, all of which, in our view, is quite healthy to the underlying market dynamic.
You mentioned 25. Scott, how difficult is it to develop a view on 2025 without knowing the outcome of November? How important is November?
It's really difficult. So we haven't got there yet, and that's usually what happens as we get into the June timeframe. So more to follow on that. But this is typically what analysts and strategists do: is you hit mid-year of one year, you begin to look forward to the ensuing year. Now we've got the elections obviously coming up later this year, and we've been bucking them thus far, Jonathan, is sort of a tail risk. And right now we think the outcomes in either candidate or party are probably equity negative, but we've got a lot of room to go here in terms of policy positioning really unfolding as we get closer to November.
Well, looking forward to seeing the work from you and the team through the summer. I just want to finish on this. I know the base case is 5,100. You've got a bull case as well of 57. Can we just talk about the bull case briefly? Are we moving closer to that? Because when I read the description of it, Goldilocks backdrop of soft landing, improving inflation, dovish Fed. Are we getting that?
In our view, we're getting close. I'd like to see those 10-year nominals come down. Again, we like to think of the 10-year nominals having an influence on how you price out the mega cap growth side. We want to see Fed funds coming down as a harbinger of, let's call it, the shorter duration parts of equities. Now, in terms of the soft landing playbook, that's still up in the air. House view is that we're still pointed towards something that's a bit more contractionary. But what I would say is that all told, we're feeling pretty comfortable that the macro influence is happening incrementally. It's not happening in a shock effect format, which usually triggers the bigger negative repercussion. So as long as we continue down this, call it, incremental path, that Goldilocks scenario sets up, whether it's second half or beginning at 25, is an open question. But again, fundamentally, we think the trajectory is still quite positive here.
Scott, it's been too long. Let's talk more often. Scott Cronin there of Citi, breaking things down in financial markets. Love the point on 25. It is so difficult to develop a view on 2025 when you have no idea what policy is going to look like. And given how policy-driven this market has been at times over the last decade, I think that tells you why it's so important. What he just said there, either candidate leans negative for financial markets, also tells you about how Wall Street feels at the moment about the options going into the end of this year. Coming up tomorrow, here's the lineup for you. BlackRock's Russ Kostrick, Sarah House of Wells Fargo, former World Bank President David Malpass, and Pooja Sriram of Barclays. From New York City, this was Bloomberg Surveillance.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffman also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew factory? And I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of, I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
From New York City, for our viewers worldwide, a very good morning. I'm Manus Cranny in New York. So tech is the challenge to this equity market rally. It pauses. Nobody likes mediocrity, and that is what Intel gave you in terms of the guidance. Sub-midpoint, not good enough. We'll count you down to the open, big tech and beyond. Coming up on the show, those futures move lower after 4 consecutive days of gains. Investors search for a catalyst with the earnings season wrapping up. And the Fed conundrum continues as Jefferson, Cook, and Collins take to the stage. We begin with a big issue. The rate debate rages on.
The bar for additional rate hikes is extraordinarily high, right? Really, really high. It really does, it does not suffice to have inflation continuing to be stuck. And that is essentially what's been happening since June last year. As much as we got excited and as much as we exaggerated at the beginning of the year in terms of our dovish expectations, I think the market is now exaggerating on the hawkish side and is sort of treating this as if the world has changed upside down and is entirely different now, even though nothing really has changed on the inflation side.
The bar is extraordinarily high for a hike, according to Max. Mike McKee joins me now. Plenty of Fed speak, which can either qualify that high bar, Mike, and help us understand a little bit more about Fed thinking. Good morning.
Good morning. Well, we've had a lot of Fed speak over the past week, and all of it pretty much confirming the idea that the bar is very high for a rate increase and also still high for a rate decrease. These are the people who've spoken so far. The higher for longer club, all of them, the 4 of them, Powell, Williams, Bowman, and Barkin, all voters this time. Next on deck, we get Jefferson, Collins, Cook, Daly, Logan, Harker, Mester, and Bostic over the next 2 weeks. So a lot more to come, but they're all singing "The Beat Goes On." There's an earworm song for you. And basically, after we have all this now, we have all of the major banks making their calls, and pretty much JP Morgan is and Goldman Sachs are the only ones who are on the earlier side of it. Morgan Stanley moved their call today out to September. Bank of America, Deutsche Bank still thinking December. Now, one of the things that's happened because of all this higher for longer talk is it's helped the markets as the U.S. goes to market with a lot of debt. Fundamentals or demand. The 3-year yesterday, good bid to cover ratio, stopped through a little bit. 10 years are up today. Last time they went out with a 2.34 bid to cover ratio and indirect bidders of 61.8%. We'll see if it's still as attractive or less so. Right now, what it's looking at when you look at the when issued is that we might see a bit of a tail, according to analysts, although right now running below so far, running above, rather, the when issued is running above the on the run. So at this point, we will see whether we can get through these auctions okay, even with yields lower.
Okay, Mike, let's see how the auction goes today. As you said yesterday, the 3s went very, very well. In conversation this morning, we have SocGen's Subhadra Rajappa and Charles Lieberman of Advisors Capital Management. Just to reflect for a moment, you know, Deutsche Bank with me this morning saying the bar is so high, exceptionally high to a hike. But I put it to you that Kashkari yesterday didn't rule out hikes. He reopened Pandora's box and he questioned the restrictiveness of the Fed's current position. Can we just square away how left of a left tail risk a hike might be? Subhadra, good morning.
Good morning, Manus. So I think that the bar is still very high for the Fed to hike rates. And I would say if there's one big takeaway from last week's FOMC meeting, it's the fact that Powell pretty much shut the door on the potential for a hike. I think they want to be patient. They want to be careful on policy, and they want to keep policy rates higher for longer. But I just don't see them hiking rates, especially in an election year. And there's also no precedence historically, I'd say, in the last several decades of the Fed pausing rates and then hiking rates. So I think they're just going to keep policy higher for longer and wait for that impact to be felt through the broader economy.
The question, though, that we must debate is the long of, you know, how long is the longer? Adam Posen with me last week saying that Powell had boxed himself in. Charles, a very good morning to you. You decided to go leap backwards beyond the jobs report and go back to the ECI, so you're firmly entrenched on the hot print in the ECI. Does that confirm the longer for you rather than the wages temperance that we saw on Friday?
Hourly earnings number, which is less accurate and it bounces around a fair amount. Employment cost index is a more accurate number. Unfortunately, it's only available on a quarterly basis. So my sense of it is that we do have a tight labor market. The economy is growing at a very solid clip. I'm very much in the higher for longer camp. And I think it's premature to rule out that the next move is a rate hike. The bar is very high for a rate hike, but if we don't see much progress on inflation through the balance of the year, I expect the Fed to leave policy unchanged over the course of the year. And then we open the door to the possibility they need to do a bit more to slow the economy down a bit more in order to bring inflation down.
Charles, you just want to have a little bit of the hedge in there. You just don't want to be. You just don't want to close off that left tail risk. So, Baddy, let me take it back to you because since the FOMC, we've had a fairly nice run. We're sub 5% on the twos. We've had a 22 basis point drawdown on 10 years. My question is that bullish run. Some people have said to me, it's a recalibration. Is that recalibration hitting the buffers? Is this as much recalibration as we will get until we get the CPI?
Yes, I think the focus is all on the CPI. If there's one day you want to show up to work, it's CPI day because you see the most amount of volatility in bonds on the CPI day. So really the focus, at least for the next week, is going to be on CPI. We do get supply this week. The refunding supply, I think, will get pretty well absorbed. But for the most part, I think that yields are going to hover around that 4.5% level till we have confirmation on the data front. I think it's too soon for the markets to get too dovish because we've had 3 hot CPI prints. We have to see what we get next week.
A nice bit to cover on Subhadra, a nice bit to cover on the 3-year auction yesterday. If I ask you to describe how the street is absorbing and demanding paper in these auctions as we go into this week, how would you describe, how would you frame that?
So typically you tend to see pretty good demand for refunding auctions. The first issue tends to be well subscribed. We have seen tails in the 10-year auctions. For the most part, a lot of this demand is coming from domestic investors as well as some of the foreign investors. The investor base in general wants to hold on to on-the-run issues, so we tend to see refunding auctions go quite well.
And Charles, to you, in terms of these auctions, how important are they as a litmus test for tolerance as we go into what's going to be a beginning of the slowdown as we go into the June season? So how important is this, that demand is strong, demand is firm, and that there is no wobble in these auctions?
Well, it's important that demand is firm, but I don't think the auctions are the make or break for the market. I think it's far more important how the inflation numbers look. If the inflation numbers look troublesome, then we're going to see a pretty bad puke in the bond market, even if the auctions go well.
What does a bad puke look at? I mean, we talk about the biggest component part of the CPI being rent. You make it very, very clear. I mean, rents are about a third of the CPI. You have your concern around that rent component. So quantify a puke for me, and in terms of the rent, they're pretty lofty.
Well, rents are a big part of the CPI, but they're less in the personal consumption deflator, and that's what the Fed is focused on. What I really care about is non-rent services. That's the part that has more inertia. It is probably not coming down as much as the Fed would like. In fact, it's definitely not coming down as much as the Fed would like. The problem is the labor market is very solid, very strong, and so labor costs are rising. And I just don't see an end to that quite yet. That's why I think it's unlikely we're going to see any more rate cuts this year. And that story will change if the data changes, and I just don't see that.
Can I ask you both your current and your forward perspective on immigration? It's a hot political topic if you're a border politician. As far as economists are concerned, it's a quasi-lid on wages. So, Badr, to you first of all, this to me is now beginning to read as a long-term 2025 issue for whoever. It's either a Biden Mark II in the White House, or it's perhaps a Trump administration. Either way, immigration will be a hotter topic, both up to the election and in reality in 2025. So is that a more pressing issue for the bond market then? We have a long lead time before immigration perhaps plays into the bond market in significant size and a cap on the immigration numbers.
So I think there are many aspects to the immigration story, right? One is the fact that you're seeing a higher entrance into the workforce, higher perhaps, participation rates. The other aspect is you're seeing some pressure on wages because the new entrants are potentially keeping wages down, especially for the low-wage earners. But over the longer run, I think immigration is going to be a positive for the U.S. economy in the fact that you have more entrants, more services side jobs, and some of the constraints we're seeing in the labor market are going to be less constrained given the fact that we have such a shortage of services side workers. And I think that the immigration story is going to be a positive one for the decades to come.
Okay, and to you, Charles, again, your perspective on the immigration side. It comes up every now and then, especially when we see the debate around wages and the kind of immigration that we have in terms of the kind and type of jobs that they are trying to find.
Well, immigration helps promote economic growth. So you have more people, more consumers, more workers who get employed, have more income to spend. So it definitely contributes to economic growth. But at the same time, it's also providing a lid on wage inflation, especially for lower skilled workers, which is where a lot of the immigrants are coming into, that part of the labor market. And that part of the labor market has actually seen more upward pressure on wage rates than the higher income workers. So it's very helpful that the immigration is coming in because it helps tamp inflation down. The question is, does it change if immigration policy changes? If we start putting up some barriers at the borders, we're going to see a tightening of the labor market very, very quickly, and that will create some wage inflation and price inflation issues.
Let's just square it all off. In terms of choice, lots of people are saying clip your coupons, but of course you want to be prepared for those insurance cuts. Sabadra, where on the curve do you want to be? We're down 22 basis points from the highs last week. Where would your choice spot be on the curve?
So that's a tough question. I would say that for the most part, we've been kind of long the belly, especially with the sell-off that we saw a few weeks back. But, the belly has outperformed relative to the wings. The 5-year especially has outperformed on the curve. So, I think where it stands, I can't say that there's any sort of interesting opportunities on the curve. For choice, I think that the front end, especially given how high yields are, it makes sense for investors to continue to plow their money into shorter dated investments because returns do look attractive on a duration-adjusted basis.
Okay, Subhadra, thank you so much. Subhadra Rajapaksa and Charles Lieberman setting their stall out on the market. Quick snapshot of what's going on in dollar yen. This is the other major discussion in markets today. It is, of course, the jawboning from Ueda. Now, this market is challenging the Bank of Japan's narrative, where he says one-sided weak yen is a negative for the economy. They've got the right to raise rates, talking about a monetary policy response to the weakening of dollar yen. This is a big turnaround for Ueda. As you can see, the market is really pushing back against the verbal intervention by Ueda, and that is critically important. Dollar yen, and again, retail investors are now selling yen, and they are some of the biggest players in that market. 3 days, and jawboning simply is not working by Ueda. You don't get bang for your jawbone anymore. Let's get a little bit more breaking news. Abigail Doolittle has that for me from Bain.
We do have breaking news regarding Bain. There is a report out from the Wall Street Journal that Bain is considering taking PowerSchool, the cloud-based software company for schools and education, private. This stock is now soaring up about 25%, 23% right now. Into today, down about 29% year to date. There is an 8% bearish short interest. So much of this squeeze, but again, the breaking news is that Bain is in talks to take PowerSchool private. As for Uber, we do have the shares lower. This, of course, after they posted a 32-cent loss as opposed to a 25-cent profit in their first quarter. The first quarter gross bookings also missed on a mobility miss, up 81% over the last 12 months. Investors wanted more. They wanted the company to at least meet, and that did not happen. Now, Intel, these shares are down 2.4%. This is interesting because they have essentially pre-announced to the downside for the current quarter after bringing that guidance down just 2 weeks ago. They're saying that this has to do with being informed by the U.S. Commerce Department that it was revoking some of its export licenses to Huawei. So that stock down 2.5%. And then Tesla also down 3.7%. The DOJ looking into whether Tesla misled investors, consumers about its EV self-driving capabilities. This, according to Reuters, Manus.
Yeah, and just on that news, we had, of course, Qualcomm as well, and they're doing much less business with Huawei, but the stock is still down 2% ahead of the open. Abby, thank you very much. Rounding up the breaking news. Coming up, the White House sends a message to Israel.
If you're going to conduct a military operation, you want to see people evacuated, but those people need to have somewhere to go. And we have not yet seen a plan that would deliver that.
The U.S. pausing a shipment of arms to Israel amid concerns about the potential military offensive on Rafah. That conversation next with Bobby Ghosh, right here on Bloomberg.
The names that move markets are on Bloomberg.
You know, with all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience.
But are you hopeful that
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
It's no secret that they want to conduct a major military operation there. We have made clear that we oppose such an operation. If you're going to conduct a military operation, you want to see people evacuated, but those people need to have somewhere to go. And the place that they go to needs to have sufficient food, sufficient water, sufficient housing, sufficient sanitation. And we have not yet seen a plan that would deliver that.
The White House deciding to pause a shipment of 2,000 bombs to Israel. Now, this is over the concerns about a potential military offensive on the city of Rafah. The U.S. is concerned about the damage the bombs could do to the city, where over 1 million Palestinians are currently sheltered. Bobby Ghosh is with me. Bobby, the size of these bombs, a 2,000-pound bomb, a 500-pound bomb, is being held up. Do we understand what scale or what impact that this pause in delivery would have on the artillery of the Israelis?
Well, no, the short answer is no. We don't know the state of Israel's stockpile of these weapons. Do they have enough? Will the withholding of, I think it's 3,500 of these bombs, will this withholding have a serious, make a serious dent? We also really don't know how much of this Rafah operation is to be conducted from the air, and therefore how badly the Israelis need these bombs. But it's not really about the numbers, it's about the signal. This is the first time the Biden administration has pushed back on something like this. It has been a long time in coming. There have been plenty of people pressing Biden for weeks and months now to hold back American weapon supplies, even from within his own party. The fact that he finally went ahead and did it is a display of displeasure that I think we just heard from his spokesperson there. I think the administration felt like they were not being listened to by the Israelis, that their concerns were not being addressed by the Israelis. And this is the administration pushing back and saying, you know what, if you don't listen to us, there have to be at least some consequences.
There's also been a huge, significant demographic tone change here. Campus, universities, pushback and protests have been escalating. The images to the world have been very, very clear. If you look back in history, I mean, we've got Obama, Reagan, Nixon, all holding back in various forms. Can you put context around the scale of this holdback by Biden relative to other presidents? Is it a piece of theater, or is it more significant than that, given the domestic pushback?
Well, they're very different strings that Biden is having to hold in his hands and keep control of at the moment, to your point, which is that he has domestic opposition, not just from within his party, but in the streets of every campus practically in this country. He has, despite those protests, he has in his rhetoric continued to be very pro-Israel. He has said over and over again that his support for Israel is unshakable. On the other hand, he needs Israel to show him that it is paying attention to his concerns. And his concerns have been very clearly articulated. They're not saying Israel should not conduct a military operation. The administration is saying Israel should first make provisions for civilians. This does not seem like an unreasonable request or a demand. And the fact that the Israelis have not apparently taken that on board required a response. And as we said, in terms of actual impact on Israel's ability to conduct its military operations, this may not amount to a big hill of beans. But it sends a message to Israel, and it sends a message to the wider world as well. And it does send a message to those campus kids who are protesting that the Biden administration is not just simply saying yes to everything Israel wants, that it is holding back. Whether that persuades those kids in the campuses, whether that persuades international opinion, that's a different matter. But Biden is trying to thread all these needles simultaneously.
Very delicately. I think the last time Obama held back on missiles for several weeks, that was 2014. As Bobby just said, we don't quite understand the scale and the impact on Israel, but it's the messaging that counts. Bobby, thank you so much. Bobby Ghosh. Let's stay in the world of politics. TikTok's parent company, ByteDance, suing the US government, setting up for a long court battle between the two sides. We've got Jackie Davalos with me. So TikTok's argument in this legal challenge, I'm curious to know what it is, because this is going to be whoever's in the White House, possibly in the new year, may well have to deal with this.
That's right, Manus. And if there's one thing that both sides of the aisle can agree on is that free speech is one of our most revered rights here in the United States. And that's exactly what TikTok is arguing, that the law that would effectively ban the app from operating in the United States violates Americans' right to free speech, to express their views and post what they please. Now, there's a few other things that we learned from their legal filing yesterday. We learned that they believe Congress did not provide adequate proof that the app actually poses the national security threat it says it does. They also said that their efforts to fence off data, which, as you remember, was actually done through Project Texas. It was a $1 billion initiative to basically fence off data, moving them to Oracle's servers. And that those efforts were ignored. So ultimately, this is going to play out through the courts and probably make its way up to the Supreme Court.
Okay, we've still got Mnuchin salivating at the possibility of getting his hands on it. Jackie, thank you very much. Jackie Davalos there on TikTok. Coming up, your morning calls from Intel to Uber. Disappointing results on the tech side, throwing cold water on your equity rally. Uber down 7%. TripAdvisor absolutely tanking, down 31% on Bloomberg.
Could face bigger challenges next.
It was going to keep Real World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond. Morning calls for you. BTIG resuming coverage of Lululemon with a buy rating. A compelling valuation, they say. Needham adds Reddit to the conviction buy list, noting a robust business model. And finally, Barclays downgrades Victoria's Secret to underweight, highlighting the competitive landscape. Coming up, Burns McKinney joins me on stocks.
Names in global leadership are on Bloomberg.
El objetivo final
The ultimate goal of doing away with the central bank still stands. The discussion regarding the central bank is primarily moral in nature. The way we see it, there has been a cultural change in Argentina. Today, wages are miserable, not through our own fault. That is due to 20 years of populism. Argentines have understood that populism is no solution, and that the quick fixes they sold to them during the last 100 years, both the criminal politicians and criminal economists, they were all false. And we need to opt for a pure orthodox market-based solution. And that's what's going to make us succeed. And that's what's underway. In fact, there are already indicators today that show that activity in the agriculture sector, in the oil and gas sector, in mining, well, our economy is recovering strongly in those departments. There are indicators that point to the fact that Argentina could really make a strong comeback.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
This is Bloomberg.
Equity markets push the pause button. We've hit a moment of reflection and introspection. Just look at Uber at the bottom of your screen, down 8.55%. We're waiting for it to roll over in the opening of the cash. A lot of these tech stocks are really beginning to sort of deliver guidance that's shaking the foundations. Intel delivering below the midpoint on a new government move to block them supplying chips. There is the opening bell. Stocks are lower. We're pausing on this rally that we've had for 4 days. Let's see where we end up for the rest of the day. This is the shape of things in the rest of the market. Completely unimpressed by Ueda's intervention, verbal intervention. The Bank of Japan governor sending a warning shot that monetary policy may be needed to respond to exceptional moves in the FX market, and still the dollar is higher versus the yen. Retail investors are selling the yen. Yields are up by 2 pips at the moment. You've got there, again, a narrative higher for longer. A whole host of Fed speakers will be coming. Jefferson, Cook, and Collins, to name but a few. We're down 22 basis points from the Fed peak last week. And crude is down 0.9%. Stockpiles are rising at Cushing, up by more than 1 million barrels last week. That and a little bit of a question about global growth is unsettling the oil market. We've talked about Intel delivering a mediocre guidance. The chip maker warns that the second quarter revenue will be hit by the news that the US ban on chip exports to Huawei. Abigail Doolittle is with me. It's a double blow, really, for Intel, isn't it, in a number of weeks?
It is. This is interesting. To my memory, it's pretty rare for a big company like this to guide down twice in just a couple of weeks. But a few weeks ago, when they reported, they did exactly that for both earnings and revenue. Revenue of $13 billion was about 5% light of what the street was looking at. And so now, as you mentioned, the range, $12.5 billion to $13.5 billion, they're saying that they're going to be in the low end of that. So it really is a double guide down in some ways. Investors seem to be taking it somewhat in stride, though. The stock down just 2.2%. If they had given a really bad guidance all in one earlier, it could have been a much bigger blow at that time. But the cause, perhaps they have a good excuse, a good reason for this. And of course, that is the U.S. government basically banning Intel and Qualcomm from selling some of its chips to Huawei as they investigate a particular, I think it's the 7 nano chip in one of their phones. The interesting thing about it, though, is, Manus, I use the SPLC function in the Bloomberg terminal, and just 0.13% of Intel's revenue is from Huawei. So it's still hard to know how much this is of an impact on their actual revenue. It will be of that amount. Maybe they see ripple effects. This stock on the year right now down 39%, and that's not even the worst year in a long time. In 2022, it fell 49%. So Pat Gelsinger really has a lot ahead in terms of manufacturing the turnaround he's been talking about.
Yeah, certainly that foundry business has not exactly delivered as was originally anticipated on the program. Abby, thank you very much on the Intel stock. Let's stick with the earnings. I mentioned Uber posting weaker than estimated gross bookings. It's a different story for Lyft, of course, moving higher after topping estimates. Jess, Draw the difference for me.
Well, good morning, Manus. It's basically a tale of two different stories here when you are looking at these ride-hailing firms. I'll start off first with Uber. If you look at that stock down about 7% now just after the opening bell. So it is on pace for its worst day since October of 2022. The big miss here, though, when you're looking at this is actually first quarter gross bookings that miss estimates. Also, if you look at the second quarter as well, just coming in shy of those expectations. So if you look at Uber's company, they see gross bookings around $38.75 billion to $40.25 billion. The estimate was around $40 billion. So that midpoint range just coming in shy of those analyst expectations. So the big thing coming up when it comes to Uber is it is integrating its Uber Eats interface into the Instacart app so it can fulfill those sort of restaurant orders placed by customers there. If you look at the A&R function right now, though, 7 buys, 33 holds, and 2 sells. But moving over, looking at Lyft stock this morning, it's actually up about 5%. So it's on pace for its best day just in about a week there. But when it comes to Lyft, this is a bit of a different story because it doesn't have different segments, say, like Uber Eats when it comes to Uber. So the big thing is about margins and then also cost-cutting controls. So when it came to CEO David Risher, who took over about a year ago, it's been through extreme cost-cutting efforts over the last year. So cutting costs by about 13% in 2023. And then also it narrowed its net loss by nearly 80% last year. So when you are looking at this, it's really more of a cost-cutting expectations that's really boosting Lyft stock, especially when you're looking at this and basically analyst expectations, more favorable outlook when it comes to gross booking. That is a little bit of a different story than when you are looking at Uber, Manus.
It is, but a brutal day for that Uber stock today. Jess, thank you so much. Turn to social media. Reddit jumping in its first earnings report since becoming a public company, posting better than expected quarterly sales. What was under the hood? Ed Ludlow is with me to take us through this. So a pretty glorious set of results, and it's all about monetization of the platform, isn't it, Ed?
Yeah, that is right. We can get into the sort of strategy going forward. What's interesting, the stock's up 4.6%, 4.5% as we speak. It had actually opened up 12%. So that initial euphoria has kind of cooled off somewhat. 48% top-line growth in the March quarter. Revenue coming in above expectations, $243 million. The street was looking for $212 million. And the guide for the current period, which ends in June, also above expectations, which is interesting. In an interview, Steve Huffman, the Reddit CEO, basically said the next phase is to improve a pretty young advertising business, which seems to be doing well. A lot of the sell-side reaction was like, okay, the ad environment's good, what's next? And, you know, you're familiar with the Reddit forum and how it works. One strategy is to tap into making it more almost e-commerce focused. There are existing ways that Redditors can make money through sort of digital gifts, avatars, or doing transactions between Redditors. The question is, how does Reddit make money out of that? And they are thinking about that. And then there's the AI data licensing business. We actually didn't hear that much about it, right? So they have this sizable agreement with Google where they can use Reddit data and content to train Google's large language models. But what's the next iteration of that? Like, who are they going to sell it to? Fortunately, we get another opportunity to ask the question because Reddit CEO Steve Huffman's going to join me on Bloomberg Technology at the top of the 11 a.m. Eastern hour. But that's the question. They've always struggled with profitability. But I think a lot of investors see a way forward if they can diversify their revenue streams.
Yeah, well, it is about creating communities that remain sticky. Thank you very much, and we look forward to that interview. As Ed said, the CEO, Steve Huffman, will be with Bloomberg Technology, 11 a.m. Eastern. Steve Huffman, not Hoffman. Okay, turn to travel. TripAdvisor said that they've got a special committee, and it determined that there is no transaction with a third party that is in the best interest of the company and its stockholders, and the market does not like this by a long chalk. Isabel.
By a long shot, indeed, Manus. Shares are edging lower by 36%. This is the lowest level since November 2023. And it's really exactly that. That a special committee said that there is no third party that is in the best interest of the company. And also, TripAdvisor also reported a worse than forecast loss. So this special committee was formed in March, and they said they will continue to evaluate offers. Bloomberg reported in March that there are some companies interested in taking over. One of those is Apollo Global Management. And for now, investors aren't really liking that. They seem to be on edge. Also, the company reported adjusted EPS that's 12 cents. That's higher than a 5 cents estimate. So this is good. The company's revenue also hit $395 million, which is 6% increase year over year. Also good. But again, it was overshadowed by the concerns of the sales performance. So this performance of TripAdvisor really just highlights how competitive the travel industry is. And it remains to be seen where the company will be heading here on out, but for now, shares are lower, and year to date, it's not looking good also. Shares are down 20%, Manus.
Isabel, thank you very much. And they've actually just halted, as you were speaking about the stock there. TripAdvisor has been halted after the stock dropped by 36%. So circuit breakers and a pause in trading on that. My next guest writes this: the impact of higher for longer rates is that it benefits shorter duration investments, and this could be a catalyst for value equities and dividend growers. Burns McKinney is with me, Senior Portfolio Manager at NFJ, joins me now. Burns, we'll come to that value and the dividend narrative in just a moment. There's multiple headwinds coming in here this morning from Intel, a double warning, from Uber not doing as well. TripAdvisor has just been halted. It's almost as if we've sort of run into a mini barrier on this sort of nice 4-day rejuvenation streak. That's to be expected. Volatility is something we're just going to have to get used to.
Well, with interest rates as high as they are, we should expect volatility. But I think what we're also seeing an example of is the fact that this has been a fairly solid earnings season. I think basically 4 out of every 5 companies have beaten earnings estimates. We don't have a lot else going on in the news right now, but this has also been a season in which those that have missed earnings have been punished by worse, and those that have exceeded earnings have been rewarded a little bit less. And specifically within that, the tech space, the consumer discretionary space, have been some of the areas that have been you've seen names most punished when companies have missed earnings. And that's really probably, as much as anything, just an example of just the overall equity markets being just a little bit stretched.
Yeah, I mean, they are, and I think they're going to need another catalyst. I mean, the earnings were supposed to fill the gap. The earnings were supposed to fill the gap if there was no rate cuts. Now we've got a couple of rate cuts potentially penciled back on the slate again. I want to understand, your proposition is that maybe it is time to get more enthusiastic about value relative to growth. If I look at growth, it's had a heck of a run. What kind of discount is value trading to growth at the moment?
It's almost double what your historical discount would be. On the base, just as a result of the fact that the U.S. value index trailed the growth index by 30 percentage points last year. Typically, when you lag by that much value to growth, value equities have outperformed about 3/4 of the time over the subsequent year and a half. And as a result of that lag, the price to earnings multiple of that value index is trading at almost a 50% discount to its growth index. And typically that's probably about a 1/4 discount. And it's not just over the last year. The value benchmark has lagged growth names by about 6% per year over the past decade. Now, obviously you say, well, what is going to be the catalyst for sort of a reversion to the mean? And equity interest rates being higher for longer could in fact be that. That tends to reward shorter duration equities. The way we sort of think about value stocks, for those viewers who've seen the movie Office Space, there's a character Milton that just watches everyone get birthday cake but him. And in many ways, that's what the value investors have been. They haven't gotten cake in a while. And we do believe that the time might be coming pretty soon for those value stocks to get a little cake.
Well, somebody else who'd like a bit of cake are the small caps, I'd say. If growth is supposed to be so robust and the economy strong and the consumer is grand, I know there's a few cracks on delinquencies, et cetera, but it's nowhere like pre-GFC is what I'm told from a number of guests. What about small caps? Because I'm being told they've got high floating rate debt, they've got a challenge in profitability, but you're a bit more of an evangelist and a believer.
There's definitely some opportunities for stock pickers within the small cap space. If you look on a price to book basis, small caps are trading really a discount to the market that we haven't seen since 1999. And that was a time that ushered in about 10 years worth of small cap outperformance. So you've got the discount, you've got the fact that small caps overall offer above average earnings growth. And so there definitely can be some opportunities there. That said, if we do slip in a recession, then the small cap area as a whole will probably be hit disproportionately hard. And so investors do need to not necessarily buy that small cap market as a whole, but rather be a bit choosy.
I was just looking at the buybacks that have been announced, and Goldman's run their own analytics on it. 930 odd billion dollars is what we're expecting for 2024, and a bulk of that has been done, but there's more to come in May and June. Can buybacks create the floor alongside 2 rate cuts and steady growth in earnings? I mean, that's a pretty good trifecta on a stool for me.
Yeah, that's 3 great legs to the stool. You know, we like the fact that companies are generating a lot of free cash flow, the fact that they're returning that to shareholders. Those buybacks are definitely a solid support for the market. And really, you know, we suggest a lot of our clients should even focus more than that on companies that are paying and raising dividends, because you know, buybacks can come and go, but you know, companies tend to be low. They tend to really be averse to cutting their dividend payments. And when they raise those dividends, those are really kind of the sweet spot of a market, especially when you're trying to keep up in an inflationary environment.
Okay, we're just seeing a small tick up in yields this morning, so that breathless rundown on yields over the past 5 days is pausing as well. NFJ's Burns McKinney, my guest this morning on the markets. Coming up, Apple gaining ground on China.
Apple is missing is AI capabilities, and that is something some of these China vendors are starting to show. China also has a leg up in the sense that they are releasing more and more foldable phones out there, which the consumer likes. That's something Apple does not yet have in its pipeline.
Chinese iPhone shipments jumping 12% in March. That conversation still ahead on Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.